Welcome along to this episode of the Grown Up Business Podcast. Super excited for today. This has been about 2 years in the making, this one, and we actually recorded one version of this that we decided not to go with because we wanted to wait till we could do it live today. So super excited for this. If you are an entrepreneur that is looking to scale your business, you really want to understand also how to do it faster, and you want to understand the hacks of private equity. What is this whole PE world? How does it work? Should you be playing with it? Should you be selling to it? What strategies do they use? How do they take business valuations from like 15 to 50 million? How do they do that? Then today's show is exactly what you've been looking for. So I'm super excited to welcome Nick Bradley to the show today. You're a private equity strategist. You've sold, I can't believe there's 27 businesses? 27 businesses, 50 plus acquisitions worth over 5 billion in exit value. That's billion with a B, right? Which is pretty epic. You are also the host and creator of the Scale Up podcast, which I've been very fortunate to be a guest on. So yeah, brilliant show. Love it. It's incredibly good. And you're author of this brand new book called Exit for Millions, right? The private equity blueprint for scaling and selling your business for maximum value. So welcome to the show.
Thank you. And I'm glad that we managed to get this. This is great. I think when we were doing it last time, it wasn't like
it was on Zoom
face to face. And this is much better. Much better.
I agree. Yeah.
We can get into the details of all the stuff that we've been talking about probably privately for years, mate.
Yeah. So, so let's start. I think where I want to start first of all is just explain what is private equity to people who may not know what it is, or I probably know what it is, but not how it works. So let's just start there, because that's the world you came from.
Yeah, it's also, I suppose, my mission now is to bring the thinking, the strategies, the expertise to founder-led businesses.
Okay.
Right, and I'll explain why I think that's important. But
yeah,
private equity, there's two parts to it, really. Private equity is a general term, of course, for private money, private investment.
Right.
Okay, so it's coming not necessarily always from institutions. It's coming from individuals, sometimes high net worth, ultra high net worth.
Okay.
And it's how that capital is deployed, typically into businesses and business acquisitions, but not exclusively. Sometimes there's private equity that exists within real estate and all that as well. That's the broader term, right? And it covers things like family offices, which we can get into, as well as sort of firms that are set up to just do M&A.
Yes.
My specific expertise, though, is in I call it private equity with sort of a capital P, capital E, is the firms that lots of business owners and entrepreneurs hear about, because they go out there and they kind of buy businesses as cheap as possible and make all this money at the expense of the founder and then sell it for me. You hear the horror stories of people who have gone through that world. And I was in that world for over a decade in various ways, which we can get into. And effectively, the mandate is simple. We want to go and spend private capital on businesses that are undervalued, ultimately.
Right.
They're not necessarily distressed, but there's hidden value in those companies.
Okay.
That with the right expertise and strategies can be leveraged, can be expanded. And the whole goal, there's a couple of metrics we can get into, but the whole goal is to substantially increase the enterprise value of those companies and do that in the quickest possible time to create a outstanding return for those private investors.
Right. Okay.
In the simplest terms, there's a lot more to it, but that's in its simplest terms what private equity is.
Got it. And how did you get into that world? So like, you came straight out of university in that world?
No. It's not quite like that.
Because you don't see a lot of job opportunities for, hey, want to work in private equity is all I'm thinking. Like, so how did you get into the world?
You ain't going to see an ad for an operating partner in private equity. You're not going to you see these things on LinkedIn where there's like 1,000 CVs. It's not that. It's an invitation to the club.
Okay.
And in fairness, I didn't really understand the world existed when I first kind of started to get exposed to it, because I was working for some very significant companies that had private equity backing.
Right.
And as I got promoted in those companies from sort of, management, middle management to sort of senior management roles, I then got more exposed to what was sitting above the business.
Okay.
We talk a lot about working in the business, on the business. Yeah. There's a whole world that sits above the business.
Really?
Yeah. And that's where sort of the capital markets play. And that's where obviously private equity plays. So I was working for News International under Rupert Murdoch in Australia.
Right.
For a period of time. And there was a lot of M&A activity there, but that's still private ownership. I then moved to a company called EMAP, which stands for East Midlands Allied Press, and second biggest consumer publisher in the UK. And I was working for their Australian sort of subsidiary.
Right.
And did a pretty good job there and got moved from Sydney to Peterborough, of all places, and ended up...
I'm just saying, as a transfer, that must have been a tough sell, right? Like you're in Sydney. Okay.
Let me segue to the story. So this is true. So I was working on a magazine called FHM.
Yes,
and
obviously.
in the UK, most guys of a certain age will know what that is.
Big in the 80s, right?
80s and 90s.
yeah.
And most youngsters would not know any idea what that is because it doesn't exist anymore.
True.
And I was the marketing director of FHM in Australia.
No way, really?
Yeah. And we grew that brand through some very clever PR stunts and things like that. And I remember we took it from number 3 to number 1 in the Australian market in the course of 18 months.
Wow.
Through some really just tactical guerrilla marketing activities. And that was noticed by the chiefs in the UK. And they said, we want to bring you over to the UK for a secondment for 9 months. And we're going to get you working on Q, Mojo, and Kerrang magazines.
Yeah.
Huge back then.
Kerrang's the metal magazine, right?
Yeah, and Q's obviously more mainstream type of stuff, but huge magazines. Anyway, that was based in London. Full relocation. Okay money, but, I'm by myself, single, doesn't matter too much. And literally about a week before I was jumping on the plane, this guy calls me up who's like the international MD of kind of all the licensing that goes on. And he goes, I've got some good news and bad news. Great, right? I tell what's the good news? The good news is we're going to double your salary. I'm like, okay, right, this is cool. And I worked out I could easily live on what I was getting. This is going to be fantastic. He said, the bad news is you're going to be living in Peterborough. And I'm like, and then this is no word of a lie. I got out. There was no Google Maps.
Yeah.
So I got out like an old map.
Right.
And I'm like, so how far away is that? And it's true. And I worked out that it was like an hour away, or an hour drive, and there was trains and all that sort of stuff.
Right.
And so I thought, well, this is great. I'll go live there, and I'll just go to London on the weekends.
Right.
But here's the other bit. He said, you're not going to be working on the music magazines. You're going to be working on the car magazines.
Really?
So I was the brand marketing manager of Car, which is a famous, one of the most famous magazines in the world, which meant that I got access to all the cars that came through. So Lamborghinis, Ferraris. Cool. I mean, there's some stories that we did with crazy stuff. So I got cars, which I love. Got involved in motorcycling as well. All the what we call the action sports and specialist interests titles.
Okay.
And it was actually called EMAP Specialist, and that business was over £100 million of turnover when I joined.
Really?
Doing 34 million of profit.
Nice.
Yeah, off magazines, print magazines. Yeah. And the reason is there was 2 really big brands in that portfolio. One was called Motorcycle News, which is like an institution if you're into motorcycling. And the other one was Max Power.
Yes.
Back in the day, Max Power was the 4th biggest men's magazine in the world. And that just printed money. It's a car magazine, but it was cars and women and everything else that goes around that.
Yep.
So I came over here, did very well there for the 9 months. They said, we'll make it permanent. And now I ended up getting promoted to be marketing director of that whole division. Then I started running one of the publications as well, and sort of started to get involved in publishing. And at that time, we were effectively publicly listed.
Okay.
Right. So PLC, but it was in 2 parts. So you had EMAP Consumer Media, which was my part, and you had the B2B division.
Right.
And so what ended up happening is they got broken up and sold independently. So sometimes you can have a business which is public, which goes back to private.
Yes.
It doesn't happen. Well, it happens a fair bit, but most people don't think of that. They think,
we don't hear about it, do you? It doesn't get news. When it goes public, there's lots of news about it. When it gets taken back, Soho Farmhouse just got taken back private.
Yeah, and it happened with where I went next, which was Getty Images. The same thing happened. So, but here's the clever thing. I didn't quite realize how this all worked, but now that I was getting up the ranks, I started to see it. And the first time I was exposed to private equity properly was when EMAP was getting broken up, and it was the last big exit, if you want to call it that, before the financial crash of 2008.
Yeah.
So around 2007, the deal was done. Business was broken up. It was a 10-figure deal, so it was over £1 billion, and private equity bought the B2B side.
Okay.
And a massive family called Bauer Media, Bauer Group, they bought the consumer side. And what was fascinating, again, so I'm there presenting in the management meetings as you do. When the private equity guys came in, there was like 30 seats full of analysts and all sorts. When the Bauer family came in, it was literally Heinz Bauer and his right-hand person. So you had 30 seats and then there's two people sitting there. And there was a joke around that apparently when he bought the business, he didn't turn up to do the deal, but a guy turned up with like a briefcase and he opened it and pulled out a checkbook and just signed the check for over £1 billion.
Wow.
Seriously.
Wow.
Like, crazy. And his whole mandate was, I don't look at this as a quick return. I look at this as a 20-year hold, and I want to make sure anything that we do with this group is going to get handed to my children in a better state than I inherited it from my parents. So
wow, what a frame to put around deal making, though.
I mean, what was really cool for me, like at this stage, so I'm, late 20s, early 30s. I'm sitting here in these world thinking, what's going on? Like, really, really naive to how this all works, because when you work for News International, it's very contained and very controlled. And now I'm exposed to different deal structuring and seeing all these things and making management presentations, getting heavily involved in due diligence from the sell side, of course. And it was just fascinating. And what was interesting though is after Bauer bought EMAP, everything that I was working on up to that time, which was kind of digital transformation, how can we move print media into digital, all the stuff that's now around us.
Right.
They were like, we're not really interested in that.
Really?
At that point, they weren't. They were like, we just want to focus on print media. And I thought, God, this isn't great. I'm not going to learn much in this environment because we all saw the disruption that was already happening at that point.
Right.
And I decided to leave. And that's when I ended up at Getty Images. And Getty Images was fully PE backed.
Right.
Like proper level, institutional, big numbers. And when I joined, they were going through a sale process from one private equity firm to another private equity firm. And I was coming in as quite a senior person. And I remember he effectively became my mentor, but a guy called Jonathan Klein was the founder of Getty. And he said to me in the first couple of weeks I was there, he said, everything you learnt at EMAP, which we respect, we don't do that here. We're not really interested in organic growth in the way that you were interested in organic growth. We only care about bolting together other businesses. So what you're going to learn here is mergers and acquisitions.
Wow, that's a head shift.
It was. So for the 2.5 or so years I was there, I was involved in just under 30 deals.
Wow.
So, say about 50 acquisitions I've been involved in.
Yeah.
The majority of the acquisitions and the deals and the mergers and everything else was when I was at Getty.
Okay.
Because we just bought everything.
Yeah, because they were on a massive acquisition trail at the time.
Yeah, and some big ones. We bought, this was just before I started, but we bought iStock Photo.
Yep.
So people know that brand.
I remember when that happened.
Yeah, huge. I was involved in a $100 million acquisition of a group called Jupiter Images.
Okay.
So I was involved in all of that, really detailed. And then a lot of smaller ones. Because the way that business worked, which I learned a lot from, is they took an industry that was just really, really outdated. Right. And invested massively in technology. So the business was headquartered out of Seattle to be close to Microsoft at the time.
Okay.
And then had a sales office in New York. But the whole strategy was we're going to buy everything that's outdated and analog, and we're going to turn it digital, and we're going to pump that through this technology capability that we have, so that instead of waiting for a book of images to turn up that you could choose something, everything you could get delivered through digital media is like within seconds. And the business, I talk about being involved in 3 exits over $1 billion mark. This was one of them, as was EMAP. But this one was a $2 billion exit from one PE to another PE firm.
Why would that happen? Why would one PE firm sell it to another PE firm? Like, why? What's the, just because I don't think I would. I don't understand why that would happen.
Because the best way I explain this to people is in the same way in the UK, you've got the Premier League and then you've got all the leagues and divisions that sit underneath. Right. The same thing happens in private equity.
Okay.
So there's a Premier League of private equity, a number of firms like Blackstone, which I got involved in towards the end of my PE career, that have the ability to write significantly big checks. Right. And there's lots of reasons for that. It's track record, it's the number of funds they've raised, everything like that. But when you see private equity exits that are in the billions, there's only the air is thin at the top of the mountain.
Yeah.
Right.
Yep.
But there's all these other PE firms, like literally thousands of them, that sit at different levels, from what we call lower mid-market to the mid-market, and then you start to get into business transactions that are in the hundreds of millions and then all the way up. So a lot of the mandate with private equity is just to get the thing big enough so that they've made as much money as they need to satisfy their investors. And then there's a bigger fish
Sell on
up the chain
Right.
who wants it.
I think when we had Ken on, Ken was talking a bit about, so he was saying to me, I think there's 6,500 private equity firms in the UK or something now, but
Yeah, it's hard to track.
yeah, he said that, but he also said, I thought, which was really interesting, he said a lot of those don't have liquidity. They just have the promise of liquidity if they find the deal or they come with the right opportunity.
Most of them don't have liquidity.
Yeah, which I was really, because
Yeah, I mean, and the other thing to understand is most PE deals, certainly ones I've been exposed to, is that investor money, that private money, only about 20 to 30% of that money traditionally has been put into an acquisition. The rest is debt.
Right.
So when you see, let's say a business is acquired for £100 million, it's not that £100 million of private investors gone into that. It's probably 20 or 30 million pounds.
Yeah.
Then there's a heap of debt. And then there's a thing called rollover, where the person selling the company has the opportunity to participate. So,
Yes.
So when you think about it, the majority of money going into that is just capital that's been, borrowed.
Yeah.
And the other thing that Ken is 100% right is that there's a thing called a capital call. So when a fund is raised, it's not like all the money's sitting in a bank account somewhere.
No.
It's sitting with you or me.
Yeah.
But I've promised to commit that money with other people. And so when there's a capital call, I have to commit the money. I can't then pull out, right? Because I've signed all the agreement. So they should have the capital accessible to them, but it's not with them at the point where the deal was getting negotiated.
I suppose Manchester United, that deal with the Glazers is probably one of the most famous of everyone suddenly realizing it was all leveraged debt, right?
Yeah, I mean, most deals are.
Yeah.
This is the thing. Like, every deal I've been involved in has been leveraged to some extent. Be that the way the capital was deployed, how it's paid, all of those things. So there's lots of different ways of doing it. That's why it's not as straightforward as if you want to sell your company one day for millions. It's not like you're going to get someone just giving you their money and all of it on the day the transaction closes. Do
you think that's a common belief or misperception that a lot of entrepreneurs have when they think about trying to sell? They think, one day someone's going to give me a massive, boatload of money, and because in my experience is people don't understand how. Some people say, I want to get out, but then you try and unpack how and what that looks like, and they don't really know. Whereas, you're selling your house. Yeah, okay, great. I'm going to sell it. Somebody else is going to buy it. They probably got a mortgage. But most people, when they're thinking of exiting, they don't really understand the mechanics of what that looks like.
They rush it, is what I find. They rush the whole process.
Right.
So, and this is probably the main reason why I do what I do now. There's a few different things that made me leave private equity, but one of them
we'll come back to that, right?
Yeah, one of them is 100% this idea that, people, this is the typical path, right? You build a business, you get it to a certain level of value and you think it could be worth something. You hear about all these big exits everywhere and all that. You might get it valued, you might not, right? But more often than not, you go to an investment banker or a broker, and they definitely have a role to play. But my view is their role is a little bit down the track to where you should start. And then you kind of go out and you put your business out there. You haven't really done any preparation on it. You don't really understand, certainly the game that I play in private equity, you don't understand that game.
No.
Right. And that's a whole different, conversation we can get into. And you're in this situation where you put it out there, a few different things happen. You either don't get anywhere near where you thought the value of the business was.
Yep.
Or you get screwed on the terms of a deal, right? Lots of people kind of feel like they've been absolutely pillaged by the end of something, right? But the thing that really upsets me is most entrepreneurs have spent, years, if not decades, building their companies.
Yes.
And we all do it for some degree, I think, of freedom and financial independence. Sometimes there's impact and all that.
Yeah, there's the 3 F's, isn't there? There's freedom, for sure, without question. There's the financial independence or financial resources, and then family, the perception that I'll have, I'll take care of my family, or I'll have more time with my family, or I'll be able to make sure they're sorted, or like those.
Or you're just unemployable.
Yeah, that's the other. That's also true, right?
But but freedom's there, right? And the thing that I find frustrating sometimes is, you're going to get this opportunity usually once in your life. Sometimes people sell multiple businesses, but it's rare, right?
But isn't that the difference? Sorry to jump in. I think that's the difference between an entrepreneur and an owner who's exiting. because I think entrepreneurs do multiple deals because they go in, they see an opportunity, they build a business, and then they exit. Richard, who you met before, like he's done 3 or 4 exits, right? So he's an entrepreneur. He's in the next thing at the moment. He's scaling it like crazy. He wants to exit in 2 years. He's got that. That's a plan. Then he'll do the next thing. Whereas I think most business owners run one business for 20 or 30 years, and that's fine, by the way, nothing wrong with that, but that then becomes their lifestyle. It runs a great lifestyle, sorts them out financially, and then they kind of get to exit. So they only get one exit event
usually. I mean, like the Richard example would be the 0.001%. I mean, we know people like that from our networks, so we see it more readily, but that's not the common way it works.
No.
I mean, and so the point is that, you know, you spend all this time, and you might have had a great lifestyle business that has supported your life, but you have to exit at some point. Everyone exits, right? You know,
true.
Without getting into the morbidity of that.
But it's true, right?
But it's true.
But it's true. You're going to leave, right? Like, do you want to leave because you're planning it, or do you want to leave because life plans it?
On your terms. And so this is what I see happening all the time when people come to me, is they haven't put as much thinking, intention, any of the stuff that really matters into the transition or the transfer of their business as they have into the growth and the build. And then they get to this point, I'm like, you realize that if you put the same amount or even half of that into planning what this is going to look like at the point where someone would find it really attractive to buy, that's going to make a massive difference, not just to your life, but potentially, obviously, your family life, generational wealth, but also the impact that you can make depending on what you want to do next.
Yes.
And in my world, because I specialize in 8 and 9 figure exits, we're talking tens of millions, literally, by stuff that can be fixed within 6 to 18 months of really understanding what drives value and what doesn't.
Yeah. And I was just thinking back to, because you came and presented, the first time I got to see you present a lot of what you talk about now, and I guess is probably in some of the book, which we can unpack, was when you came and presented to one of my masterminds, and we were in the Nobu Hotel in London.
Great. Wasn't that dinner nice?
Hotel. The dinner was amazing.
I know.
Right? It really
I remember
was.
That very well.
Yeah.
That was a great night.
Yeah, it was a fantastic. But I remember because you came in and did a whole session in the morning, right?
Yeah.
And one of the first things that you asked everybody in that session was, "What's your life-changing number?"
Yeah, that's right.
And I remember I was sat at the back of the room, and it quite upset me, if I'm honest, at the time. It, like, that number really
triggers people.
Yeah, it did. It triggered me, and I was sat at the back of the room. And just talk me through, like, why is that important to understand? But also, why do you think people get triggered by people? Why does it trigger people?
Let me ask. I'll answer the first part first, and then get into it. A lot of people don't think of a lot of what I talk about in the book is reverse engineering from an outcome. Right?
Yes.
Well, you can do it in anything, right? I think it's a key to life as opposed to just business.
Totally right. You can do it with health.
Yeah, and 2 things happen, I think, when you talk about exiting your business and a biggish number, right? It can feel quite intimidating, quite scary. The other thing is it can expose what's not there. So if you suddenly, one of the most painful things in life is when you realize the gap.
Yeah.
Right? Like, you think you're going to get this, but you're not, because the gap is, and then all of a sudden you've got to maybe change your whole thinking.
Yep.
Right? So if I go to someone and say, and the question is, what is your life-changing number? There's 3 parts to the question, so I'll say them. So it's, what is your life-changing number?
Yes.
Why does that number matter? So we do this in sequence, right? I do this on stages everywhere, and I get everyone to do it. And then the third question, which I think is the real kind of kick in the guts, is what you're doing now going to get you there?
Yeah.
And that's the thing that triggers them.
That's the one that got me.
Because when you look at it, sometimes it inspires, but often it goes, I ain't building anything that's going to get me to that.
Yeah.
So what do I need to do differently? And that can be either, as I said, positive. Usually it is if people reflect on it, but it can also be overwhelming. And then the other thing is, like, so let's say, and the number's always somewhere between 15 and 30 million, usually on average. Like, you do get I want $1 billion. It's like, okay. But, and then that's the average, right? So from all the stages I speak and people and then, how do you feel about that? And why does it matter? And then sort of people struggle a little bit with that, but they sort of get into, well, because, I want freedom, I want to provide for it. It's not usually about them as much as it is about what that's going to enable them to do.
Yes.
Some of it's about status.
Right.
But from a positive construct as much as anything else, like, I just want to see if I can do it.
Yes.
Right. Test myself. But then, as I said, the final question, most people, it depends obviously on the situation, but most people have a gap there of either knowledge, capability, thinking, mindset, whatever it is,
Network, baby.
how to do it.
Yeah.
And so then they question themselves about why they said the number. Why did I say that number if I'm not doing it? And then you get confliction. And that's what you would have gone through to some extent. But it's what a lot of people go through. It's the reason why I asked the question, because it's firstly to say, you know, I actually believe most businesses can get to any valuation you want, depending on what you're prepared to do and the runway. But when you put a number like that out there, you're kind of almost saying to yourself, well, that's what I really want. And that can be scary.
Yeah. I also think the realization that what you may have sunk quite a lot of time into and effort actually isn't going to get you to where you just said you want to go. It's like, oh crap, I've just spent 5 years of my life building this thing to get to this point, and that's not actually going to get me to the point I want to get to.
Yeah.
I think that's painful, isn't it? I mean, that is...
Anytime you set an intention that you actually really care about. So that second question, why does it matter, grounds the first question. That's why it's the sequence. So okay, I want 20 million and I want to do it for these reasons. And those powerful why reasons then get you emotionally attached to the number. And then you look at the third and go, oh, and that's where that sort of feeling of kind of dropping, if you like, or Or most people go, they either do one or two things. They go, well, actually, I'm content. I'm just going to kind of keep doing what I'm doing, because that number, as much as I'd like to do it, I'm just not going to do it, right? And that's fine, you know. Or the majority of people, certainly that I work with, go, how do I do that?
Yeah.
Now, what don't I know, right? But there's a big mindset piece to both of those things. Like one's a bit like, I'm just going to give up because I don't want to do it. No judgment on that. The other is, I now need to lean into it, and what's it going to take? Yeah.
Or I need to get educated, or I might need to completely re-engineer my model to get me to that kind of number.
Yeah,
right?
yeah. And sometimes, I mean, one of the things I probably do more than anything else with the businesses that we mentor and advise is business model change. You know, heaps of them. I worked with a client in the UK recently. We doubled their revenue in 12 months by just changing the cycle of how they sell to their customers from a 12-month to a 36-month program.
All right. So just unpack that for us.
So education business.
Okay.
They were business model. I've done quite a lot of this on my podcast about what defines a business model. It's not just it's how you make money, but it's the way that you package it all together.
But most entrepreneurs don't get an education in how to build a business model, though, right?
No. They think about, they know the various components, you know, the customer you serve, the products, all those sort of bits, but they don't quite understand how you can flex different levers to get different results.
Or what the levers are even.
Yeah, there's 5 in my mind. But, you know, the way that you actually play with that can make a big difference. So in this situation, really good revenue, you know, really good sort of product that's a 12-month cohort-based product.
Nice.
And I said, why is it 12 months? Right? The goal is quite a big goal, what we're trying to do. It's a building businesses type thing. That's not a 12-month outcome, right? It's at minimum, it's a 3-year outcome. So why aren't you selling a three-year or a 3-stage process? Even better, don't even give an end.
Yeah.
Set the outcome and they take as long as they need to, but then you've just increased your average order value, your lifetime value, to some extent recurring revenue, depending on how the whole thing's built. And so we did that. This guy's very entrepreneurial, like really good fun to work with. Launched it, and it just took off. He just sold it as a 3-year program. And did it so you're committing to a certain amount of money in the beginning for the first year, discounted for years 2 and 3 if you sign the contract for that, but not much. And then all of a sudden he was taking a program that was, say, 25 grand a year to, I think it ended up being 58 grand for the 3 years.
It's a big uptick, right?
It is.
Yeah.
When you think,
but no extra effort in the sales cycle to do that.
No. And what was happening is people were finishing and going. So there was no additional upsell other than something quite small that was powerful for the right people, but there was no ascension to anything. And as I said, like, you know, you're selling the wrong thing. People don't care about time. They care about the outcome. So if you understand that the outcome can be, you know, done in stages, so they're progressing, they're seeing results, you can have more time with them. So if you want to do something with them longer term, right, like, you know, different products and services or whatever else, they're going to have more trust with you. So let's just do that.
Nice.
And it worked. So that's kind of what I mean sometimes where, when you're so stuck doing the same thing, you don't know exactly what to focus and affect. But these are all things I learned in private equity. They're not really tricks. I mean, when you understand them, they're very obvious things.
Yeah.
But most people just don't know how to ask the questions that unlock that.
Yeah. I mean, I think with all this, it depends, doesn't it? Again, on your education, your background, and how you got into the business you're in as well. And also, for me, it's like the business model needs to evolve and change, but that doesn't necessarily mean you know what the other versions of or other options of the business model could be, right?
Yeah. And you get close to it, right? Like, I find sometimes even with my businesses, if I'm too close to them all the time, it's a subjective way of thinking about things. I need objectivity, right? I need someone to look at it with a fresh pair of eyes to be able to offer different suggestions.
Yeah.
I think we all have that because you get too emotionally attached sometimes to the things you're creating.
Yeah. Well, that's the artist's curse, though.
Yeah, I'm definitely that.
I think when you create stuff, you worry about putting it out in the world in case people don't like it, and then you love it, but the market might not, but you keep going with it.
You mean like taking 2 years to write a book?
I don't we need to start there. I mean, we can go there if you like, but I mean, I think so. Just I want to unpack something though that you've opened up, and I think it might be in the book, and maybe that's the good segue. But you just said there were 5 levers. So was that stuff you got taught in the private equity world to look at then, to walk in and go and how did you assess a business to being undervalued versus distressed? Because I think turning around distressed businesses is hard graft. I'm not saying you can't do it, and there are people who are very good at it, but like that's a different model and a different play than saying actually we're going to find undervalued assets. So like how do you evaluate something to see what are you looking for when you're trying to find undervalue?
So we're looking at the potential for faster growth,
okay,
or more scalability,
right?
And they're different things, right?
Okay.
So scalability is what I can expand from the foundations that have been built,
right?
Which ultimately does drive growth. But growth rate could be just what you're currently doing is working very well. We want to accelerate that with our resources. Now, those resources can be money, because obviously private equity is putting money in. It can be networks. It can be just better strategies. So when we look for hidden value, it's more that the person who's founded the business or is running the business has done certain things that are attractive to us, the foundational layers. And I do talk about this a little bit in the book.
Okay.
Certainly in the second piece, because again, I translate this back to what a business owner should be thinking.
Yeah.
And then from that, we focus on the value expansion levers, the pieces around that. And more often than not, the value expansion stuff that private equity does is not what most business owners do, right? So, and we'll go through it because I talked about it. You're right. The LinkedIn post yesterday, I talked a little bit
you dropped a
about
great
this.
LinkedIn post on this.
Yeah, and what I said in that, just to kind of, so I think it's worthwhile going through it here, is I said that you've got five main things that you focus on in value creation in private equity. The first 2 are what I call table stakes. It's what every business owner just does. So it's revenue growth and it's margin expansion.
Yeah.
So how much more can I sell and how much more profit can I make from that? If I'm really honest, I think lots of business owners don't think too much about the second one.
They don't focus on margin, not anywhere near as much as most people are obsessed with other things quite often, and they're not tracking it. Let's be honest about it. They get to the end of the year and then they find out how much margin they made.
I believe there's only 5 real metrics a business should track, right?
Okay.
Not 40, and one of them is that. But if I go through this piece, so you've got revenue growth, you've got margin expansion, and then after that, so that's the table stakes. After that, there's 3 things that private equity does at an elite level, right? And this is what we're taught and trained on. So the first one is capital structuring, and that's really just a kind of clever way of saying leveraging debt.
Yep.
Or not being afraid of bringing capital into your business from whatever source to fuel growth and expansion.
Okay.
And lots of business owners, because I think we're taught that a credit card debt is bad and all these interest rates, I should never borrow money. Quite often it's not about going and selling equity, in your business to get that. That has its own benefits and also drawbacks. But it's just making sure you're confident about how you can invest behind what you've built, right? So private equity are more detached from the fear.
Yes.
of that because you're kind of just used to working with big numbers, right? So it's like whatever. And we're trained on that. So you've got that. So there's that. Like this is working. We're going to put lots of money behind it and we're going to scale it. So that's hidden value, right? Like you're already doing something good, but you weren't brave enough to actually go at it. We're just going to go at it. Right.
Because we're not emotionally invested, because we don't have the story, we didn't start it, so we don't know the people, we're looking at it.
We've done a very, very deep level of due diligence through this process too. So we know the cracks in the plan and what's not working and whatever. So we're looking for the things that are good and bad, so risk and upside, because we want to be able to scale this thing.
Yeah.
Right? Scale from the perspective of how I talk about it. So capital structuring. Then the fourth piece is acquisitions. So there isn't a mandate out there in private equity which is not about growing through expanding through acquisitions, buy and build, roll ups, different terminologies for it. But it's just the quickest way to grow value if you know what you're doing. It's also one of the quickest ways to destroy value if you don't. But again, like
that's the yin and the yang, though, right?
Well, like people come to me. You must see this with what you do. I want to do acquisitions, and I'm like, you're not. There's no way you should be. You're looking to an acquisition to get out of distress. Like, you don't buy businesses and put them on chaos.
No.
Right? You buy them when you've got the foundations in place. And then you do it quickly and you do it with precision and then you culminate everything together. So that's the jewel in the crown of PE is that strategy. And then the last one, the fifth area is what we call the value expansion. So different from margin expansion.
Yes.
And that's all the various levers which flex the multiple when you sell.
Right.
So the way to think of it is, in my world, the valuation methodology is an EBITDA multiple.
Mm-hmm.
So effectively, I say net profit. There's a few differences to that, but the net profit of your business times by a multiple. The multiple is always set by the capital markets, and every market has a range. So you can't change that. So if you're in education, just to use that example, the range is typically between 6 and 14 times.
Yeah.
Now, the thing that's really fascinating to me is a business with the same profit, let's say, it's doing a couple of million. One of those businesses, two businesses together doing the same profit, one of those businesses could sell for 12 million.
Yes.
The other one could sell for 28 million.
Yes.
Right? But they're the same profit. And this confuses business owners. Well, hold on, they should be the same. The value expansion is all the clever things. There's 15 different things I talk about in the book around this.
15?
15.
Okay.
I call it the 15 reasons why your business won't sell to private equity. It's my most downloaded episode of all time.
Really?
It's
we'll link to it below, by the way.
It's actually in a couple of MBA programs in America as well.
Is it really?
Yeah.
Wow.
Yeah,
that's cool.
It's been cool. I mean, like created it one night. I thought, why if you've got a business and private equity doesn't buy it or a sophisticated buyer. So whenever I say private equity, I normally talk about someone who's a bit more advanced, right? Why are the reasons? And what sits in there are some of the things that people talk about a lot. It's if you've got key dependency on the founder,
always.
Lack of recurring revenue, lack of defined brand, chaotic culture, non-audited financials. So there's quite a lot of specifics in that. They are all things that you can change, but they often take 12 to 36 months, sometimes more depending on the state, to fix.
Right.
So what you can't do, and this is a bit of a pro tip, if you want to sell your business, don't bring in a new CEO 6 to 12 months before you sell. Right?
Oh, interesting. Okay.
They haven't got time to do anything.
Right.
So if you've had the business for 15, 20 years and then you've suddenly changed leadership and you're now the chairperson of the business and that person's had no time to affect it, and I then try to buy your business, well, how do I know if they're any good?
Yep.
If you've got someone in there who's had a year or possibly 2 years of the budget, the process, the delivery,
yes,
then of course that can be a kicker on the multiple.
Yes.
So the way to think of that value expansion is it's all about the multiple. Certain decisions are going to increase risk, certain decisions are going to increase value. And if you know what those things are, you can then play the multiple range so that you sit at the highest point.
Yes.
And again, if the profit's quite high, every point on the multiple could be tens of millions of dollars.
But
quite technical this for everybody.
Well, I think it's interesting because obviously for me, if firstly, out of the number of people that go out for sale, a small percentage of people actually sell, right?
Yeah, 70% don't sell.
70%.
Yeah,
I think
you different figures, but it's around that.
Yeah, which But that's largely because they don't know this stuff and it's not set up to sell, right?
Correct.
It's like saying, okay, if you want to sell a car, here's all the things you should check. Number one, the tires should be good. Number two, it should be service history. Number three, it should be clean because that increases the perceived value. There are a bunch of things that make that car sell.
100%. Yeah.
And yet, accountants don't tell business owners these are things you should. They just focus on the one, not the rest. I'm a big believer in, and I spoke about this on your podcast where. For me, the team is the thing that will actually hold the multiple back and, put a buyer off and coming in to buy it, because it's like, if you're not here, this whole thing falls apart. Well, key man dependent, that's a problem. And if you haven't built a leadership team, then there's no way this is going to continue without your input, right? So I'm a great, I think if you want to live the dream, you got to build the team, right? So it's all of that.
Very nice.
But it's true, right? It's like, if you don't build that component, the value you're going to get on the multiplier is significantly less. So I've always said to clients that building teams is one of the best ROIs you'll get. And they'll say, well, okay, great. If I've got to hire 4 key people and the salaries are between 70 and 100 grand, okay, so I'm going to spend £400,000 more. Yeah, I'm saying, but you're going to take the multiple from 8 to 16 or whatever, not just because of that, but it's going to increase.
It's also going to give you, we look at it, I often say sometimes that the private equity playbook is really people and numbers. Right, if you really want to simplify it.
Right.
Because we're probably more focused on capability upgrades than we are anything else.
Right.
So when I was an operating partner for a while, which is effectively when a business gets acquired by private equity, they put an operating partner over that business. You're supposed to, realistically, you're there to mentor the founder and the leadership team on how they can be successful under new ownership. But you're also there representing the firm in terms of the strategy. So you're not the numbers guy. You're the kind of business strategy operations guy. So usually it's an XP back CEO, that sort of stuff. But when you're going in there, what you're really doing is saying, can this founder grow and scale this business? We think they can because we've bought the business, but if there's risk there, we'll just swap people in and out all the time. Yeah. This is where it gets a bit ruthless. And some people go, oh, private equity stole my company from me. Well, they're not going to steal your company from you if you're delivering, but their mandate on delivery is a totally different level of delivery than maybe what you did before.
Yes.
Right? Because there's very precise goals that they and kind of hurdle rates and things that they have to achieve to satisfy their bosses, which is the investors.
Because they've made promises that they need to keep.
Yeah. And there's a thing like, I'll give you the 2 metrics because I think it's important.
Yeah.
The 2 key metrics that I was focused on was one's called MOIC, which is multiple on invested capital.
Right.
And the other one is IRR, internal rate of return. So MOIC is, to break this down, it's how much money I deploy into a business to build out a group of businesses and then what I sell that for in the future. So let's say I buy a business for £50 million, and then I put another 50 million in to buy companies, and we buy a couple of businesses together. So the amount that I've put in, regardless of where it's come from, is 100 million.
Yep.
Okay. I'm expected to sell that group usually within a 3 to 7 year window, right? That's the kind of average, for somewhere between 300 million and 500 million.
Okay.
So that's why, as an asset class, private equity is just off the charts. Unless you're doing strange crypto stuff, you ain't going to get that growth. I've just turned 100 million into 500 million.
Yeah, that's a great return. Thank you very much.
Exactly. Bit of alchemy, right? So that's what MOIC is. It's the multiple on the invested capital that I'm trying to get. Okay. It's usually within a ratio of anywhere from 2 would be considered bad. So 100 million becomes 200 million. Sounds good to me, but...
It's doubling your money, but that's not, compared to what the market does or what that sector does, that's not considered great.
But if you put it against, but it's still if you think about it, that's still 100% return.
I'm not...
It's off the charts.
It's brilliant. If you're getting 7 to 10% somewhere else, it's pretty...
I know. And the game starts to get interesting at 300 to 500, right? So when you think about that, you're tripling, quadrupling the whole piece. It's crazy.
Yeah.
So that's the first piece. And then the last piece is the IRR, the internal rate of return. That's the speed at which the investors get their money back.
Right. Okay.
So if a fund performs really well, it's because they've done those 2 things. They've invested in businesses, they've increased the multiple, so that MOIC equation's gone up, and they've exited or liquidated at a point where everyone makes a lot of money at the quickest possible time.
Which would be what, 2 to 3 years would be a quick.
That's normally 3 to 7.
Right. But 3 years would be a quick.
Yeah, 3 years would be quick.
IRR.
Yeah, so 3 would. So if I bought a business, and the way to think of it, like it takes on average anywhere from sort of 6 to 12 months to sell a business anyway. So the idea is you have the build or the value expansion piece. That can be a period of, say, usually it's a couple of years up to 36 months.
Got it.
And if it's working really well, you just keep on doing it.
Yep.
To a point. And then the sale process, when you go down that route, it's going to take you, let's say, a year. That's why it ends up being that 3 to 7.
That makes sense.
The opportunity, I think, for business owners now, though, if they're doing acquisitions, so forget the private equity thing, is still to buy businesses subscale for lower multiples and then bolt them onto what they're doing, because, whatever happens, when you buy a business, say at 2 to 3 times the multiple and your business is worth 8 to 10, as soon as the deal is done, the value of that company that you bought is now at 8 to 10.
Because it's part of your group.
It's the arbitrage.
Yeah. But the challenge with that, I would say, and I've seen this happen, is where people start bolting on other businesses, but they don't have their own management team sorted.
It's the Franken business.
Yeah. So
I call it the Franken business.
Oh, right, okay.
So think Frankenstein, big, green, ugly monster.
Yeah.
Was
he green?
I don't know. I think there's a new TV show and he's kind of not. But either way, I like to think he's green. We had that term in private equity. So when someone tried to do a buy and build and then bring it to us, happens all the time now.
Right.
It's not just the people piece or the way it's integrated. It's the strategic sense of the acquisitions.
Yes.
So like they buy businesses and they think, oh, that business looks good. It kind of fits with what my business is. And then the Franken business is, well, that heads from somewhere else. Term. The arms here.
Yes.
Yes. How are we going to bring this together and make sense of it?
Yes.
Because they're just totally different markets or customer segments or products or whatever. But sometimes people get so trigger happy that a deal comes in front of them.
Yep.
They buy the business.
Yep.
And they don't realize that they can't integrate it. Doesn't make sense longer term. And then quite often it can actually bring your core business backwards.
That's the strategic clarity piece, isn't it? Which most people don't have.
No. And this is
about anything, by the way. They don't necessarily have it about their own business, let alone about like trying to start buying stuff.
No. They hear, there's lots of marketing out there right now about how, baby boomers retiring and they call it the silver tsunami. Or
it's the next big push, isn't it? I mean, we had for the last 10 to 15 years, the big push was buy property, because properties, that's the growth zone, and that's kind of finished now. And the next big thing is buy businesses, right? Yep. Because the margin property's never going to go up in at the rate it went up over the last 50 years.
You've had
that bubble's done.
The people that have been very successful in sort of what we call acquisition entrepreneurship have been real estate investors, because they've got some cash.
Mm-hmm.
And they can go and do deals with people retiring, and they can put 10 to 20% down payments down on these businesses. Those deals can be done all day long, right? Because most people are turning up trying to do these no money down deals.
Yes, which is crazy, right?
Which no one's. I mean, people say to me all the time, "Oh, what do you think of that?" And I'm like, well, if John's had a business for 30 years and his whole identity is in that business, unless he's distressed, right, sick or something else, he ain't going to just give you his business for nothing.
No,
I mean. Crazy, right?
Well, and also the other thing for me with that whole model is, firstly, you have a level of responsibility to the person you're buying the business off to keep it going, because that's 20, 30 years of their life.
Yeah.
And secondly, if you mess that up, they won't want it back at that point.
Well, that's sometimes the thing. It's like, oh, well, what happens if you do make it? Oh, I'm going to give it back to you.
Yep.
I don't want it. I gave it to you in the first place because I don't want it.
Yep. I've had someone go through exactly this, where they went through it, bought it, found loads of skeletons in the closet after they'd bought it, stuff that was horrible. It had been completely overinflated and various things. Them giving it back, just walking away. But obviously the people don't want it, but they're like, no, we don't want it back. And they're like, no, you don't.
There is a part of the market where it does work, and that's where you are buying turnarounds.
Right.
Where.
But that's a different skill set.
It's a different skill set, and it takes a long time, and actually it's high risk. But the point is, it's like, to use your car analogy, if the car's been, I forget what the category is, but if it's been in an accident beforehand, it's a bit of a mess.
Cut and shut, I think.
Okay, there you go. So in that situation, the history, there's a problem. So, you might get that car for nothing if it's not a runner, right? Because you're going to have to do a lot of work to get it working again, right? But a lot of people go out there to these baby boom businesses, and they're good businesses, right? They're not distressed. They're just, need to be maybe optimized or modernized maybe. But the business owner ain't going to give it to you.
No.
But if you're a real estate investor and you've got the liquidity from what you've done with real estate, and you turn up there with the right team, the right attitude, all that sort of stuff, but you've also got the money to be able to leverage. Again, if you've got a bit of cash, you can then go and borrow debt much more easily as well. Certainly in the US, it works brilliantly.
Yep.
You can do deals like no tomorrow, roll-ups, and there is a lot of activity happening there where people are buying in industries because they've got a bit of that capital to deploy.
Do you see more activity in the US or the UK, or is the US just structured better for that kind of thing?
I do most of my work these days in the US on this side of things because of the SBA loans,
right?
Small Business Administration loans. I'm not sure exactly what they've got here.
We don't have that kind of thing, not in the same way.
So.
We don't.
Yeah, because I've spoken to a few people who play in the space here. It doesn't seem to be as easy. You've got to go find investors and stuff like that. I mean, you can go and debt finance against assets and things like that on the balance sheet, but it's a lot more difficult. So in the US, it used to be really easy because you've got to be a US citizen to do it, but it was a 10% down payment. So as long as you put 10% in and the business stacks up from the due diligence, because there's obviously some financial analysis on that, you can go get a deal done.
Yeah. Which is great, right? Like, I mean, brilliant. That's like fueling the economy.
You know why it stopped, though? You'll love this because this lends into your kind of world.
Okay.
Because people were buying the businesses and not knowing how to scale them.
Ah, yes.
So all of a sudden, there's these loans out there for these businesses, big loans, and the businesses are going backwards at a rate of knots because a non-business owner has decided to become a business owner.
Yeah, that's my pet hate, really, is where people get sold on a course on how to buy a business and let's just say, for example, they were a taxi driver for the last 25 years of their life, right?
Yeah.
Which is fine. Nothing wrong with being a taxi driver, right? Good, right? But now suddenly you're buying a £2 million business in manufacturing that you know nothing about, don't understand it, haven't got the skill set, and you're somehow going to just magically be able to run that. And like the learning curve is horrific. And I've seen and had to help people recover from doing that, where the business, they don't know what they're doing with it because they have never built anything.
Right.
But I've got other clients who've, you've met some of them as well, who have used the whole idea of, buying and scaling, but they know how, their core business is very good. They know how to run that. I always think I think you should do it as a bolt-on, and you know how to run a great business and you build a great team. Now go buy as an expansion strategy. Absolutely works. We've got a client of mine, Steve, who's just about to complete on his third or fourth of veterinary practice at the moment, cool. Which is brilliant, right? And it's
because he knows that.
Great. And the banks will lend to vets really well, because they lend a certain amount per vet in the practice. There's a formula for it. The banks view vets as very low risk. So he's great, and that will roll, and he'll do great, and he'll build a group of 6, and they'll work. And you go, well, great, that makes sense. He's already built and sold one practice in the past, so he understands that industry, so it's a great strategy. But if you were, if you were a pub landlord and you suddenly started buying vet practices, the probability of success is not great, right?
No, you've got to have a vet on your team, yes. Like who's part of one of your partners.
Yeah. But even so, you're learning on something. I always think it's much harder to go into that situation because, I think one of the biggest things that causes businesses to fail is they get the capital piece wrong, right? The repayments. They don't factor in how much it's going to cost to pay for the business, whether it's the banks or anyone else. And then if sales drop 10%, they're suddenly in trouble because the margin.
There's a thing called debt coverage ratio,
right?
Which effectively is, again, because PE you're borrowing like millions and hundreds of millions of debt, that you have an equation around it. It's quite complex. It's not one to sort of unpack, but it's it effectively shows you at what point of risk tolerance you shouldn't do the deal.
Really?
Yeah.
Wow.
So the idea is, and I forget the exact percentage because it does change depending on industry. So it's quite complex. But if you ask someone about debt coverage ratio, they can probably do it if you're evaluating companies. And the idea is that you shouldn't borrow certain amounts. So you've got the seller finance piece sometimes. There's always a component of some form of that. Sometimes it's called an earnout. But it's the same concept. You've got the debt that goes into it. You've got your own money. And it's effectively the ability of the business to pay the debt off over the defined period of time with a tolerance level against what you were saying in case the markets drop or whatever else.
Yep.
And if you get too close to the wind on that sort of thing, the equation goes red to kind of give it a bit of a color. And that means that even if you can cover the debts, it's too close based on macro factors or whatever for you to do it.
Now there's an opportunity to create an app or a program or something because that would be that would save a lot of people, I think. But also people get deal fever, don't they? Have you seen deal fever kick in before?
Yeah, deal heat, as we call it, same thing. Yeah, you've got to be. The one thing in private equity that I really valued in the time I was there was we were trained to be detached. So
How do you train someone to be detached?
you bring in US Special Forces.
Seriously?
Yep.
What?
Yep.
Like, okay, explain.
So the one thing about PE I would say as a general term is that the training you get is excellent, right, across all different levels. So it's almost like doing an MBA but more practical because it's kind of real stuff. So imagine you learn everything like you would in an MBA, but you're actually doing it in real time.
Right.
So it's that. So I had this experience where we had some Delta Force guys, I think it was. They came in and they said that a really interesting sort of concept. So the idea is that when you're in the thick of battle in Afghanistan or whatever else, and you see your best mate get shot next to you, horrific, right? How do you cope with that?
Yeah.
How do you not freeze? How do you just, that's kind of like the courage under fire type of thing.
Yeah.
And in the military, you're trained to deal with that. You're trained to kind of psychologically detach yourself from the environment that you're in to be focused on the goal. Otherwise, people would just, crash because emotionally we can't deal with that.
Built for that.
So at a much smaller level, I don't want to kind of say it's anything like, seeing your friend get killed. The stakes are high in private equity. We're dealing with big numbers all the time. And if you let yourself get consumed by that, the feeling of risk is high.
Right.
So we were sort of trained to be unemotional, I suppose is the best way, from any relationship. That's why there's a certain clinical nature to how I can operate at times.
Right.
Based on what I was trained to do, because I'm there to get the goal.
Yes.
Right. So I'll say whatever I need to say to someone to get the goal. Well, yeah. That's
how did I'm sorry, I just have to.
No, it's really interesting.
No,
I mean,
like,
really
how do you train that? Like, how? Well, I mean, role play. Were you in a classroom? Were you in what?
You learn certain elements of how people's psychology works.
Okay.
So a lot of it's around influence and persuasion.
Okay.
So it's principles of that. It's also, if I'm negotiating with you in a role play situation, if you do that enough times, you start to, because you'll be trained to say something.
You get muscle memory, right?
Yeah, it's the same as like anything.
Yeah.
So it's more that than anything else. It's not like, we're getting thrown into, there were certain things we did which were more pressurized situations, like getting out there and climbing a mountain. And one of the things I did in my career, this is true actually, like crazy thing. I was in a program called Inspire, where there was two teams of 6, and we were sent out to the Brecon Beacons.
Okay.
And we had to compete against each other over the course of 2 days.
Okay.
And everyone has a chance to lead certain things. So you lead with your 5 teammates. It sounds crazy, this, right? But I'll tell you one thing that happened, and it was how we learned empathy, or how we could understand empathy. So turn up, we go in this room, middle of nowhere, it's cold. Okay, Nick, you're leading for your team, other person's leading for the other team. Okay, everyone else has to stay out of the room. You guys are coming in. You're going to have 5 minutes, and we're going to give you a brief. So we go in. They give us these maps, confusing, whatever else, all the lines that, is that steep, is it not? You kind of work that out. But, we're not trained on any of that. They give us the maps, and they say, okay, you've got to go from this point. You've got 3 hours. You've got to go from this point to this point. Okay. And you have to carry a certain amount of water. Okay. And there was, depending on how much water you decided to carry for the team, right?
Well, you personally?
No, the team.
Okay. So
I'll explain how this all comes together. It's quite interesting. Will determine the points that you get. So first and foremost, you've got to get there quickly, and you've got to carry a certain amount of water. So you've got to make the judgment. Do you want to do it slowly with more water or whatever else, right? You've got 5 minutes. Okay.
Wow.
So what the hell is all these jugs? It's like different types of jugs. Like, I'm not joking. There was different containers as well. So you're like, what?
So you've got the variation of different containers to figure out too.
I'll bet. And then you've got to think, okay, well, I can carry this amount because I'm quite strong. There's 3 guys in my team. There's 2 women. Maybe they can't carry that. So we'll give the 5-liter containers to the women. Yeah, 5 minutes. Clock starts now.
Wow.
Okay. Now at the end, this is the killer, right? At the end, right? Because I told you it's about empathy. The guy goes, okay. So just so you know, you as the leader can't carry any.
Oh.
I know.
Oh.
So then 3 hours, not joking you. So you can't go back now, right? So I
Well, after you've made the decisions about who's carrying what.
I'm thinking I can carry a couple of big
right,
things,
yeah,
right?
yeah.
So in that situation, you just have to carry the amount because you don't carry so we had to work out how we could carry the same amount of water in whatever containers were there. But here was the lesson, and it was very visceral, right? Is all I could do for 3 hours as we're walking through the Brecon Beacons, up and down whatever route that I'd chosen, was encourage and support.
Okay.
At the same time, the 5 people, as much as they know this is a thing we're learning, they're just pissed off. They're like, why did you make that decision? Now, they weren't in the room, right? Now, at the end, you get feedback and everyone goes around and does like almost 360 degree, like in the eyes type of stuff. And, I'm pissed off because you did that or whatever else, but it's quite interesting. It's quite hard. And then the guy comes up, the facilitator, and goes, what did you learn? And you go, well, I don't know.
5 minutes is not a long time.
I'm freezing. But the context was this, and this is the powerful. He says, sometimes in business, right, as a leader, you have a very short amount of time to make a critical decision, right? And no one else knows the context of that decision.
Yeah.
No one else is in the room.
Yep.
And you can't do the work for the people, but you have to decide what that work is. And your job as a leader is to support them the best you can, right? And so that 3 hours of, are you doing okay? What can I do? Encouragement, motivation, really hard. About as hard as you could possibly learn that lesson. I've never forgotten it.
Yeah, I bet.
But that was the lesson. So it's things like that. So how do you learn it? You learn it through those types of things. That's what I mean. The training's off the charts.
Yeah.
And there's other examples of similar to that. So we firstly understand the context. We understand what it feels like in certain situations. We're trained viscerally to be able to manage under fire, right? Because in situations like that, as I said, I've never forgotten it.
No,
so,
gosh, yeah. I mean,
does that make sense? So
yeah, completely. Because there are, that's a really great way of learning empathy.
Oh yeah, and there was other ones we did as well, but similar types of stuff around different capabilities as a leader. So a lot of it's about high level leadership, but also how. Even down to really tough decisions that you have to make. So if you have to fire someone, how do you get yourself in the right state to that? Because sometimes it might be unfair. Like, you fire someone who's not performing in private equity, like they might be running a company or something like that. Oh, you haven't given me any time. No, I haven't. But you're fired.
Yeah.
Because the 2 metrics that matter.
Yeah.
MOIC, internal rate of return.
Yeah.
Clinical.
Very.
I said once, I think on stage.
Do you find that hard? Like,
that's why I left.
Right.
I left for a lot of reasons, but one of the main reasons was I just found that was not aligned to my personal values.
Yeah.
In the end, in the beginning, I quite liked it because it was this world of it. It feels. I sometimes say that private equity is kind of 2 things if you really broaden it out. It's unapologetically about money, or certainly has that tradition. I had that experience. I do think it has changed and evolved. But it's world-class business strategy. It's world-class execution, like precision, discipline. And I suppose the reason why I say now about the private equity blueprints playbook for founder-led businesses is like, even if you could learn 10% of some of those things.
Yeah, 100%.
And I talk about building an investor-grade company, whether you choose to sell or not, it's irrelevant to me. But an investor-grade company provides the optionality to do whatever you want.
Yes.
Because it's so well built.
Why do you think, because I think there's a really interesting part in this, which is I think a lot of entrepreneurs struggle with consistent execution.
Mm-hmm.
And
100%.
And I
Fully
think,
agree.
And I think a lot of them, the emotions run the decisions.
Mm-hmm.
So I can think of recent conversations with a couple of people where we know we need to let somebody go. They're not a good fit for the team. They're underperforming, whatever. Then there's always that story that runs around. Oh, you don't understand. They're going through a problem at the moment. Their wife's got cancer. And I'm not saying we shouldn't be human and have a set of values, but this person is having a massively detrimental drag on the business, and we can't achieve the goal that we've said we want to achieve this year unless we deal with that. We address that, right? Yep. And yet avoidance kicks in with 1,000,001 justifications as to why we shouldn't, because it's Christmas. Yeah, well, okay. If you do this in January, it's still going to be a pretty crappy thing to have to do to somebody in January. So if you know they're not right, the minute you know they're not right is when you should do it, right? Like, And I think that's that lack of ability to make those, like you say, decisions under very stressful situations. That's what separates people who can really scale from people who can't.
Yeah, I agree. And you see it in the world of sport, probably more obviously, transparently than you do it in business, right? Because maybe it's so pure in terms of the goal. But like, how you see people like Michael Jordan from all sort of different angles, apparently not a nice person, whatever that means, right? But certainly someone who's maybe a bit more difficult and a bit kind of focused because he's so ambitious.
Yeah.
But then there's the result.
Well, it was tough on people, right? Like if you didn't perform, he wasn't interested.
Yeah, and high standards. But there's no like, I'm just gonna, paddle around the edges of this sort of stuff. I mean, I think the one thing I would say is even though I mentioned before about the clinical decision, there's a difference between the decision and then the execution, right? So is the decision for that person who unfortunately is not very well to leave the business? Do they have to leave the business because if they stay in the business is not going to perform? Yeah, they got to go. Okay, great. So that decision's made. Then it's the execution.
Yeah.
So in PE we weren't like ruthless in terms of like, it was just clinical, you're out, no context. Sometimes it was depending on the other factors, but there was usually a lot of strategy in the how. Like, should we do it this way? Should we do it that way? Should we not? What's the effect of that going to be on the culture?
Yes.
It was all through the lens mainly of the business. Like, is it going to be good for the business or not good for the business? Good for the person, not good for the person was probably secondary. Right?
Yeah.
Because we're here to deliver a result for shareholders. And that's where I think private equity gets a bit of a bad rap at times because people just can't relate to that thinking.
No, I would agree with that. I think, but that's the grown up, isn't it? That's where I talk about being a grown up business is you have to have a responsibility as a CEO or founder to make the tough decisions because A, no one else is going to make them.
Yeah.
And B, if you're the grown up in the room, then you're the one that's got to say that and got to have the difficult conversation. Now, the execution of that, as you rightly point out, with this person in particular, it might be that we end up giving them 3 months worth of money to go so that they can, go look after their family, do whatever they need to do. But so that's keeping the values alignment and integrity piece there. So we're not just like dropping them on the head because life's tough, right? People have difficulties, things to challenge, things happen, but someone has to be the grown up in the room and go, this isn't working. And whether that's with a supplier as well, right? It can be a supplier or anything like that. But I think that ability to make difficult decisions when no one else is in the room and it's just you and the decision is a skill set.
Oh yeah. And that's why I think some certainly when founders do sell their business to private equity, and I kind of get really involved in helping people decide whether that's the right path.
Right.
There's a certain type of business owner that will absolutely thrive in that environment, and there's some that I would say just to not do it. Right. Do not even go there. Really? Yeah.
What, personality based?
It's personality more so than capability. Sometimes it's capability in terms of I think there are founders that are great at the beginning.
Yes.
And they're creative and they like the chaos and all that sort of stuff, and they get a business to a certain level, but they're not good at scaling it. I think there are sort of scale up CEOs, which you talk about, and there are others that are kind of really good founder sort. And sometimes, there's obvious examples where that transition happens in big businesses all the time, right? So I think there is the capability side, but it's more again the emotional side of it. So if you like structure, if you're not afraid of governance and having other people kind of pick at your stuff and challenge you, if you're kind of like happy to let go a little bit, because you remember you've owned this thing and now you don't, right?
Yep.
And participate in a more team environment, then that can work really well for you in private equity. But a lot of founders, they don't like that.
No.
Like they like to be
in control,
the cog of in the center of the wheel. Exactly. So those sort of people I think struggle because if anything, private equity is about structure and discipline.
Yes. Which is the complete opposite of the freedom that a lot of people get into being an entrepreneur for.
Exactly.
That's the complete contrast, isn't it?
And some people I like the environment. That's why I was in there for so long, because I could see the value in that.
Yeah.
And I like the way that the structure I could see how doing things in a certain way with relentless execution drove results that were just outstanding. And for me, if I'm in something that's too creative, I just get frustrated.
Right.
Like I know there's an importance
because you can't consistently execute then.
Yeah, it's to me, it's a shiny object thing. Like if I work with a business owner and they're always chopping and changing, a lot of the time people bring me in so I get them focused, right? More than anything else. Like I'm like, why are we having this conversation again? Right? We said that this is, I had this one recently. In fact, having one, partly the plane I'm jumping on tomorrow is going to be this conversation. It's like, we had this conversation 6 months ago. Why are we doing it again?
Yeah.
I don't know. Half the time the answer is that.
Yeah.
Like,
because I'm bored.
Yeah, because 5 people told me this is what I should be doing.
Right.
Okay, great. Okay, so let's unpack that decision, right? And then you get into it, and then you show them, are we clear on the goal? What's the goal again? Oh, the goal is to exit the business for 20 million in the next 36 months. Okay, great. So let's have a look. We build this new thing out, right? And you've created all this complexity, and the thing that we're supposed to build that's going to drive the value, who's going to do that? Oh, I don't know.
Well, isn't that about keeping the main thing the main thing? That's like in sport, I think that's, if you look at Michael Jordan, really good example. He only ever played for one team. He never moved around to different teams. He was one team, all in, I'm going to build this, that's where I'm going to play. And that's what I think makes him so incredible, is that he never moved around. He did the three-peat twice in the Bulls, and that was it. And I think he was unbelievably focused on that as an outcome. Whereas I think every time, I also don't think entrepreneurs understand the S-curve very well, or get taught it. I mean, Harvard teaches it.
Mm-hmm.
I cover it off in some of the stuff that we do. But I think that S-curve is not understood, that every time you go start something else, you go down first, you go negative first. It takes a massive drain on resources to do anything before you come up. And that could be 2 or 3 years of that. And if you're trying to get out in 3 to 5, right? Most people I talk to, if I say, when do you want to sell? They'll say sometime in the next 3 to 5 years.
Mm-hmm.
That's
right.
That's always the number that comes up, right? Like arbitrarily, it's
sometimes you hear 10, but I get 3
most
to 5
people it's 3 to 5. Yes, most people think, well, it's probably about right, and it's probably achievable, and that's kind of, they don't really know, but that's the number that gets kicked around. And I always think it's really just sort of interesting, because it's like, can you stay focused for 3 years first of all? Because actually, if you look at the business you've got, it's got so much random stuff in it that we've ended up doing, and you haven't got enough time in 3 to 5 years to do lots of S-curves. That's the other thing. You haven't got the time to do S-curves. You need to find the one that's going to go and then ride it really hard for 3 to 5 years. Whereas every time you get distracted and go start again, we do another S-curve all over again.
Yeah.
And I just think
that's why you see people have businesses for like decades,
right?
And they're still trying to work it out. I mean, there are people out there I've seen who have been, let's call them entrepreneurs or business owners, depending on how we define it, and they're still stuck, right? They might be making just enough money to survive and getting just enough freedom to survive, but not really enjoying it.
No.
I've had companies I've looked at that literally they've been around. One of them I actually helped exit in the very beginning. Jim had his business for 16 years, and it took us 24 months to get it ready for sale, and he sold it for an 8-figure sum. But he couldn't do that before. Because I explain it like he's on the treadmill. He kept doing the same thing. He'd get to a point, then he'd sabotage it, right? Might do something crazy. And then he ended up getting quite sick in the end. And just as well, we got the deal done just before that happened, or around that time, because he wouldn't have sold the business after that.
Yeah.
But 16 years of just...
Yeah. I one of my favorite conversations with somebody in the first 3 years when I started coaching was somebody said to me, what can you teach me? I've been running this business for 20 years or something. And I remember, and it was really funny because I think I'd been coaching for 3 years at the time. And I said, the challenge is you've been running the same business for 20 years. So you basically got 20 years, 1 year experience done 20 years. I said, in the last 3 years, I've coached whatever it was at the time, 16 businesses, a year for 3 years. I said, so like in terms of experience, I dwarf you. And he was like looking at me like, and he's like, oh yeah, wait, what? And I was like, you've just done the same thing for 20 years. You don't have any other experience. You're just doing the same thing on repeat and wondering why you've hit the scale up ceiling, right? When did the light bulb go on, or when did the light go off for you in terms of private equity? When did you know it was time to leave?
Yeah, so a couple of things happened. It kind of was building up a little bit anyway, because I got sick of the way we were treating certain situations and people, like I explained beforehand. And it just didn't feel right. And not, again, I want to be really clear, 'cause some people think I hate private equity. I don't at all. I love it. I think...
I don't get that vibe off you. I don't get the vibe that you hate it.
People sometimes think that I'm sort of the antithesis of it because I left it and I'm kind of like the black sheep type of thing. So I like to context that by saying, there like anything, there are good and bad sides of anything. There are private equity firms out there that still operate in certain ways, quite ruthless and relentless, and there are others that are now awesome partners with business owners, like amazing. And you've got to, one thing I often say, but you've got to be able to pick and choose
Yeah.
who you sell your company to. So there's a choice there. But that was all sort of happening at the time. I was involved in a couple of deals. Things were happening internally with those deals. People were kind of literally fighting each other because of the amount of money that was involved. Really bad, sort of like, behind closed doors conversations.
Yep.
Just felt really bad. So that was going on at the time. Then my father came back into my life after being away for, around 36 years.
Wow.
He left when I was 2 and then came back just as my first daughter was being born.
Wow.
Yeah, so this was the big one. And so he was a really successful entrepreneur. He's actually from Scotland, but he moved over to Australia when he was younger, and he had 2 really interesting entrepreneurial journeys. The first one, he had a jewelry business in Collins Street in Melbourne in his late 30s, early 40s. Yeah. And it got blown up.
It got blown up?
It was next to the Turkish consulate, and there was a terrorist attack in the 80s. And because he was next to that, the shop got blown up and struggled massively with insurance around that, because apparently insurance doesn't cover terrorist stuff particularly well.
No, it doesn't.
Which is crazy in my mind. But anyway, so he lost it all. He lost it all at 42. And I didn't know any of this, right? So I found this out afterwards. And then he started another business, which is called EnviroChem, and he was bringing environmentally friendly chemicals and pesticides into Australia for all the crops and things like that.
Okay.
And did extremely well for that. So basically he crashed, rebuilt himself, and all this was going on. So he came back into my life around that time, and I started to get this weird epiphany of the people that we were screwing over a little bit in private equity. All these kind of really courageous founders were a bit like my dad.
Wow.
And I was like, and then it all culminated. I talk about this a little bit in the book. It culminated one night where I cracked the 2 molars on the right side of my drawer, because I went to bed and I woke up and I was so stressed that I'd like literally cracked this.
Grinding your teeth?
Kind of more than grinding. I don't know. I was obviously not awake when I did it.
Yeah.
But I remember waking up thinking, I thought I'd actually been bitten by a spider or something, because it was like really painful and quite swollen. And I remember going to the mirror in the bathroom and looking at it and going, what the hell's just happened here? It's like 3 a.m. So I ended up going to the doctor first the next day, and they said, oh, it looks like you've cracked your tooth. So go and see the dentist. And yeah, I cracked it. So I don't know how you do that. But the dentist said she'd seen this before in financial services people, high stress, usually traders.
Right.
That they had this kind of, not always teeth, but certainly something like that, which is pressure. So that was all going on. And then we were closing this big deal. So one of the last big transactions. And then my dad gets diagnosed with cancer.
Wow.
And he dies within the year. So
within a year?
Within the year, yeah. So he got diagnosed, when was he? Died in November. And we found out about around January that year.
Wow.
So he's come back. And what's interesting about that relationship is when he left, of course, everyone had all these bad things to say about him, which happens when the relationships break up. So, he left because he didn't want to see you or hang out with you or love you or any of that sort of stuff and all this. So, but when I met him and heard his side of the story, it was totally different. There were synergies between the stories, as you'd expect, but like his view was very different to my mum's view. So I built up this relationship with him as I was becoming a dad, right?
Do you mind if I ask? Like, I'm just curious, like, what was the story in his head then? He was like,
yeah. So I was told. I'll tell you what I was told first. That he was a bit of a sort of playboy philanderer,
right?
Cheating on my mum, all that. Apparently, I was seeing a child psychologist back then at sort of 2-3 years of age.
You were
well,
saying?
the way it worked is the psychologist was sent in by the courts to observe me with my father.
Wow.
I don't know any of this. I was told this. So whether it's true or not, but this is, and apparently I got myself into such a state whenever he was around that the courts then said that he couldn't see me. Or said it was in the best interests of him not to see me.
Wow.
Now, I don't know how that was orchestrated or what the truth is, right? But that's what I was told. And of course, I didn't see him. Now, his explanation of that many years later, because he flew over from Melbourne to London and we met up one night in a pub in Soho.
Okay.
Imagine what that's like, right? Like I'm sitting there thinking, what's going to happen? He turns up and we had this amazing night, like just, lots of tears and stuff like that. We end up going out for dinner. that was the beginning of a sort of thing. And he just said two things. He said, listen, I wasn't in love with your mom, right? At that time. And, I tried, but I wasn't, right? And when everything was going on with how I was reacting, so he said that did happen. He just thought it was best that I wasn't around for a while. And then he said, I tried multiple times through the years to try and reconnect with you, but each time that was not successful. And I do remember a couple of times, but that was all hidden from me,
Right.
certainly when I was younger. When I was a bit older, I remember he tried. And then at that point, I was so convinced that he wasn't a great guy that I then said, I'm not going to ever see you.
Right.
So that changed a little bit towards the end because I was in the private equity world thinking, I wasn't feeling great about that. And then I was going to be a dad, as I mentioned. Then he reached out, and it was my wife who actually meddled because she didn't tell me this. But she'd had a conversation with him over email.
Right.
Let's get a long story. And had suggested that I maybe should at least have a conversation.
Wow.
And she was right. It was one of the best decisions or best things she ever did, because when my daughter was born, Arabella, and I realized there's lots of complexities, right?
Yeah.
Being a father and all that. Like, even if he wasn't great, what's he like? I need to make that decision. And then I met him, and he was awesome, right? And then he ended up dying very quickly. As I said, I went to his funeral. I did the eulogy, actually. And there were hundreds and hundreds of people at the funeral. If you're going to have a funeral one day, if that happened, you'd be just so proud of maybe the impact you'd had.
Yeah.
And all these people were coming up to me because they knew about me. He'd been apparently talking about me for years. I was his only child. And they told me the stories of how he'd helped people, like all the things he'd done to help them in their businesses and their life. Incredible stuff, like unbelievable stuff. And I'm like sitting there going, wow. So this is all going on. And then I'm thinking, I'm in this world of all these people who are just cutthroat money. That was my experience. And then I'm sort of having things happening there that I'm misaligned massively. And so then I didn't decide to leave exactly at that point, but after my father passed away, I went to a Tony Robbins event.
Yeah.
You and I have talked about this. So one of my really good friends said to me, you need to get yourself into a different room. And the other thing I'll say about private equity is they're not very good at putting you outside of their box.
Right.
So you're in the box and you're in the team, you're in the club, and don't want you going too far outside the box.
Right.
So going to a Tony Robbins event for 4 days was like a total, like, whoa, what the hell was this all about?
Yeah, the first one you do with Tony is usually like that anyway, to be fair.
Yeah, I knew sort of, it wasn't like I didn't know what I was getting into. I sort of knew that to some extent, but didn't quite get it. And then, but I did two really important things. Two really important things. This was 2018. I decided to leave private equity.
Okay.
Not straight away, because he does this thing where he talks about burning the boats.
He does talk about burning the boats.
And it's very romantic.
Yes.
And it can also be very stupid.
Yeah.
So I thought, I'm earning a private equity salary here.
Yes.
And I've got, a couple of kids now. My second daughter's come into play. And we've got a big house and all that. And I'm like, can't quite just leave. So I did take one last private equity.
There is a bit of a strategic, I think it's really interesting. I'm assuming you're talking about UPW, right?
Yeah, Unleash the Power Within.
Right.
Yeah, it's great. I still love it. It's great.
It's an amazing event. I've done it. I think I've done it twice and crewed it once. But I think what's interesting about the whole burn the boats thing, and I get it, and I do, but I also think there is a context of, he then says, don't walk out of here and make radical decisions, right? Where, I ignored that. I walked out of the first one and then went home, and the lady I was married to at that time, and I just went, this isn't for me. I don't want to have children with you. This is not my life.
It has that effect, doesn't it?
And then I picked up 2 suitcases and left. So I completely ignored his advice. And I think the reality is, had I had a little bit more emotional awareness, I would have gone, look, actually, this needs to be handled with a little bit more, a little bit more delicately and kind of navigated away from this.
Tony's not delicate, is he? Nothing he does is subtle. Like dancing around, then jumping over fire and whatever else you do there.
Yeah.
But so that was the one decision. And thank God I didn't kind of just go back and quit. I thought that through. And the second thing also I was a bit more considered about was, I said, I'm going to start a podcast. And the reason I did that is didn't make that decision. I said I'm going to start to build my profile outside of private equity was the main positioning.
Right.
Because I thought, you're there for 4 days and you're immersed, but you do have time to think. And I was there by myself, so I wasn't talking to anybody. I was like, going back at night time and I was journaling stuff down. And I thought my wife had a quite successful blog, and I thought, well, maybe I could do a blog. And then I thought, well, I do a lot of speaking anyway. Maybe I should do a podcast. And that was the beginnings of Scale Up Your Business,
Right.
which I launched a year later. So I launched the podcast while I was doing my last private equity gig. Don't know if you know the full story.
No.
Launched it in February 2019. It blew up. So this is before good old Stephen Bartlett was around the place, just, taking number one spots. It was number one in the business podcast for a long time, a lot longer than most people, around about 3 months. It was always like 1 or 2 for ages above everything. And I started to get people coming to me then saying, can you help me? And those first 25 episodes was just me, no interviews. So literally telling stories of stuff that I do now. I still do the solo episodes, but talking how to be a great leader, how to do certain things, all the things I was taught in private equity. So all these people coming out to me, and I'm doing this last private equity gig. And as I said, private equity don't like anything that's outside of that lane. So the chairman of the business, I was the CEO of this company. Chairman was like, we don't like this podcast. We don't like this podcast. It's not quite what we're used to. You're the CEO of this business.
Yep.
That's not good. And this all started right quite quickly, particularly when there was getting quite a lot of notoriety. And then I said to my wife, I said, what will you do? And she said, well, can you start doing some mentoring for these people reaching out? I said, yeah, I can, but I'm employed, right? So, she goes, just, be strategic, was her words. Right. So I started taking on a few clients, sort of just on the side. And that started to get a bit busier. And then I thought, this is going to be a thing. I can actually go out there and there's people who need this. And so the podcast is getting bigger and bigger. And then about a year into it, I get called into the boardroom of the chairman's there. And he goes, we're going to fire you unless you quit the podcast.
Really?
Yeah. So here's the cool bit. He's like, I love this bit. I reach into my bag and I pull out the resignation letter.
You already had it?
Yeah. Because I already planned it. I knew it was coming. So it wasn't like a shock. And that was it. So I left. And then that's now, 6 years later.
Amazing.
I know. All happened quite, those few years around when my father was around, it was all quite condensed. But that was the epiphany, I think, the change that I needed. Because I sometimes ask myself in hindsight, would I have left had that not have happened? I don't know if I would have. I definitely wouldn't have left had I have not done the Tony Robbins thing. And I don't think I would have done the Tony Robbins thing had my father not come back and then had, you kind of think sometimes in life, things happen for a reason. And I think him coming back and then dying suddenly and that being such a big thing is so disappointing. It's because I'm just reconnected with
I was going to say, like, on the one hand, really massively disappointing, and on the other hand, massively grateful that you got the opportunity to reconnect at all. All
of it feels, without getting too ethereal, like the whole serendipity piece and things like that, like things happen for a reason. If I look back now at the patterns of things that happened at the times they happened, it feels much more than just chance.
It's not.
No. Yeah, well, you know more about this than I do.
Well, but I mean, there's my favorite sort of Japanese quote of all time, or Chinese quote, wherever it comes from, is that you live life forwards and understand it backwards.
Yeah, that's how it felt.
And I just think that's so true, because when you're in it, you don't realize the pivotal moments. You don't also realize why sometimes the universe is trying to knock you in a different direction and go, look, you have a bigger role to play. You have other things to do, and you're stuck in this, and this needs to change.
Yeah.
In order for you to even get to that thing. And sometimes I think we don't see that when it happens.
No, I agree.
And I think sometimes that's quite hard to understand. When things go wrong and you go, oh, yeah, but actually that thing that went wrong led to the pivot in the business that led to us going in a totally different direction, that led to us tripling the business. Like you look back and go, oh, now it makes sense. But at the time it was just absolute chaos and the business was in trouble or whatever. And it's like, yeah, you have to have a little bit of faith that there's a bigger play going on here than it's just you on your own trying to figure this whole thing out.
So two things happens, which will kind of ground that point, right? So when I was at the first Tony Robbins thing, where he does these meditations and they're quite long, sort of 30 minutes, and they're full on. But they he's trying to connect you a little bit with maybe parts of you that you don't, certainly in my world, right? Like the sort of heart mind thing. It's very mind. And I remember this voice, it was my voice, but I remember this voice coming into my head so clearly saying, trust yourself, right? Which was then the impetus to go and make that change. And then what I created after that, I went to one of Tony's other events, and And I created this mantra, and I say at the end of every podcast, which is be grateful, be brave, have faith, and show up. And where that came from, interestingly, is it's called Date with Destiny, this big week-long
Changed
event.
my life. That event completely changed my life.
There you go.
Completely. And I was fortunate that I got to do it. Sorry to jump in. I did it in the Bahamas with Sue.
Yeah.
And we did it when Tony still did it all. He was well enough to do it all. Obviously now he doesn't. He only does short chunks of each day, and other trainers do the rest of it.
Yeah.
So we actually did the whole 5 day, or because it was 4 days, and then you had a day extra on relationships that he did with Sage.
Yeah.
That event forever changed my life completely. UPW was a great kind of gateway drug, if you will, to Tony, but like Date with Destiny completely and utterly changed my life. And to the extent that I would say it transformed who I was as a human being. I don't know what it did for you, but for me, I was really sick at the end of Date with Destiny. Like I got really ill. They had to call a doctor to the hotel room.
Really?
I got really ill.
In what way though? Was it it's just emotionally? Because I mean, sometimes I think if you take so much on, it can show itself physically. You know.
Yeah, I mean, without being too graphic about it, there's a process you go through where you're sort of towards the end of it, kind of like trying to, it's not an exorcism, but you're trying to get rid of all of the limiting beliefs and all of that kind of stuff, right? And it's fairly full on and fairly intense. And it's at the end of 3 days where you're physically exhausted, you're mentally exhausted. You know, it's designed to break you down, right? I mean, you know that now looking back on it, but at the time. And I played full out, went for it completely. And then when we got back to the hotel room that night, I just started being ill, like, but not ill like you would be sick. There was stuff coming out of me that I didn't know what it was. I've never seen it before or since. At one point we were talking about like throwing up black tar coming out of my and I'm just like, I'm seriously freaking out because I'm literally shivering on the floor in the bathroom and between various, I'm like, I don't know what the hell's going on and what's coming out of me, but it's not anything I've ever seen before. And genuinely, like, I don't know what it was. I just know that it was stuff that had to come out of me that was obviously emotionally stuck in me in some way. And I'd freed it and lodged it, and it was just trying to get the heck out of my body. And I didn't realize, but they actually have doctors on standby for a Date with Destiny for that sort of stuff.
Yeah.
And I ended up with a doctor. Sue called a doctor. They came to the room. I ended up being on a drip for 24 hours to rehydrate and all that kind of stuff. It's never happened since.
How'd you feel after though? I mean, when you recovered, did you feel
lighter? I mean, just like lighter, literally I had some kind of thing removed from me that had been a toxic, I'd use, don't mean this to be dramatic, but I would say almost evil kind of thing inside of me
that makes sense. That makes sense. I think there's, because I do a lot of Joe Dispenza meditations.
I'm thinking of going to, thinking of going to his retreat in January.
He's really, I haven't done the retreat. I've got a few friends. I've got some friends who have really lent into it, and they're like totally different people in a kind of odd way.
I don't want
to change too much, but I'm like, you know, one guy's just take everything he believed for ends now the opposite. So I think there's things, but there are, I know in those retreats and also some of the stuff, there's lots of kind of caveats of like or warnings of what you're going to go through because of the there's a great book called The Body Keeps Score.
Yes.
And we store stress and we store anxiety and we store all those things in our body and manifest into disease. That's the principle. And actually, I think that's pretty true. And if you go to that experience you had, and Dispenza does it as well, it's kind of getting rid of all that toxins in your body, which is emotional stress held in muscles and live in other organs. So I do believe there's something in that for sure.
Yeah, I can only speak to my own experience with that one, but there's definitely some stuff I've read around trauma being trapped in certain things 100%. That leads to illness and those kind of things. And which is interesting because just related back to a business for a second, I actually think most entrepreneurs, I don't know if you would agree with me on this, right? I think a lot of entrepreneurs are walking around with unresolved trauma.
I think, well, entrepreneurs may I'm trying to think, is entrepreneurs worse or most people?
No, but I'm saying, I think because running a business at times is quite traumatic. right? Like it's genuinely quite a traumatic experience, isn't it? Like
it's high degrees of stress, but it's high degrees of upside and downside.
Yeah, I'm not saying it's not good, but I'm just saying, like, for example, I'll give you an example of this, right? One of my clients had a board of directors and his competition headhunted 5 of the 6 directors.
Yeah.
And competed, set up against him and just, like that's traumatic, right? Like, that is quite a traumatic experience. Now, I'm just saying, I think sometimes entrepreneurs have just unresolved trauma and the business, you have to deal with it at some point. Because otherwise it will cause that self-sabotage cycle.
Well, I think and I've said this before, so it's not known. I've got prostate cancer, right? You may have forgotten.
I had forgotten, actually.
Yeah, so no, it's not. It's people react in different ways. It's not bad, but the point of it is, I'm pretty sure that the misaligned values and trauma that I was going through in that private equity thing,
right? Not
just for a couple of years, but for an elongated decade, being in an environment which you kind of love and hate for different reasons, right? But the more you start to realize what's important to you, you're holding on to that. I'm pretty sure some of the stress and tension that I was holding on to there, and certainly not probably living up to what I believe now, because my belief systems are very different now than what they were, right? I'm pretty sure that there's an impact there.
How are you now? Like,
there's different grades of this stuff, right? So they have these different scores called Gleason scores, and I'm a 6, which effectively means active surveillance.
Right.
But it's been 2.5 years now, and nothing's progressed. But it's one of those things you can either have it treated, which is not the best thing to do at a young age, or you can kind of wait till the medicine gets better and better. There is something I could do right now to have it removed, and you might say, well, why would you not do that? Because I've got the best physicians on this, the Michael Jordans of this stuff, and they're like, if I was you, just kind of keep doing what you're doing, and at some point we might have to do something, or it could be a 20-year problem, 30-year problem that is not an issue for you.
Yeah.
But you have to get your head around the idea if you got it, and it does change certain things, certainly things like health insurance.
Yeah, that's going to show up differently, right?
But I do believe. I think about unresolved trauma. There's a very intense 10 to 15 years, which again, if I look back to what I do now, which feels effortless versus it wasn't that then, there's a lot of tensions.
Do you think that's being out? So the way I'd say that's out of flow. Yes.
Yeah, that's the way to think of it. Yes. So definitely not flow state. But not recognized in the time. So it's not like I was in that situation thinking, oh, I'm not in flow state. It was more like, this is all I know.
Yes.
And this is as good as it gets.
Yes.
And I'm just going to lean into it.
Yes. And I did exactly the same before I got seriously ill and had the heart attack and stuff.
Yeah. You've been through it in your way. It's the same. Yeah. I think it's a very similar thing. I mean, different.
I think your body. You're the third person to tell me about that book, and I'm still not read it. So I'm going to go.
Oh, it's hard. It's a hard read, by the way. It's not. Not easy.
Do we ask ChatGPT to give us the summarized version of the whole thing?
I would get the summary first before you. It's long.
Is it?
Yeah. It's good. It's good, but you know what it's going to tell you.
Right.
Right. It's going to tell you that emotional trauma held too long is going to manifest itself into physical things like heart attacks.
You give me the breakdown. Thanks, man. I appreciate it.
And if you don't do something about it,
yes, you're
going to end up dying young and whatever. So, so it's basically like you've got to deal with your shit. That's what it's basically saying. Okay. And okay, great. Well done. But most people, right? Most people don't do with it. Like, as you said, entrepreneurs particularly, and they kind of let things go, and it builds up and it builds up. It ages you. And I think a lot of people give up on stuff just because they don't deal with the trauma more so than the fact that everything is not possible.
Well, there has to be an event. I think there's usually an event, isn't there, that has you suddenly realize the trauma needs to be processed or dealt with. There's usually some kind of event, right? I
think so. I mean, I was lucky. That's what I think about with my dad. I was very lucky that happened because, as I said, would I have left? Maybe something else would have happened that transition, but got another 6 years, 10 years in that world. I mean, I don't know. I mean, I wasn't looking great. I wasn't very healthy back then. I was a lot more overweight. I wasn't drinking more, so I wasn't healthy.
How have you changed then? So, because like health, and I know we've had conversations outside of today, like other times, like health has become a really big thing for both of us, right? Like it's become a core value.
Yeah, it's such
in a
an
different
enabler
way
for things. I think as well. Like it's the foundation, right, of everything. I was always into health before actually I was in private equity because I was involved with, I used to own a gym years ago, and I was involved in Men's Health magazine when I was working for Rupert Murdoch. And I've done lots of marathons and ultra marathons. So it was always kind of, not that I think that's healthy, by the way. That's a different conversation.
What, ultra marathon? Is that the 100 miler?
I've done I've done 100 miler, and I've done lots of 50 milers, and I've done around 24 ultra marathons in total.
Wow.
But I don't think it's healthy. So the time, not to say that you shouldn't do it, but the time that I did that was in the decade that I was in private equity.
Right.
I think I did it for two reasons. I did it because I was running away from kind of who I wanted to be. So now I don't run as much anymore, interestingly.
Yeah, that's fascinating, isn't it?
Doing stuff that's more in flow.
Yeah.
But then I ran a lot. Like I get up and run a marathon on Sundays. Like just do it. And I'm sure, I think it wasn't as clear as it is now, but when you're running something like that, you're fully present in that moment. It's quite painful, of course, running a marathon is not easy. And I think it was a way of almost desensitizing me from everything else that was going on.
Yeah.
Subliminally, right? But yeah, I mean, I wasn't healthy. I was, working late, not sleeping, eating pretty well. So I looked okay, but overweight more so than I am now. Running these ridiculous marathons and ultra marathons. I wasn't doing anything really consciously around my health. And I'm sure that combined with the emotional stress is what potentially causes, for me, it could have been that. I definitely think there's a link there.
For sure.
That's how I feel. Some people would say, "Oh, it just happens to people." I don't know.
No, there's too much data now around that, and I also think entrepreneurs. I think one of the biggest things they buy into is the story: I'll just put off my health because I'm building my wealth, and then I'll fix it later.
Yeah.
And without realizing that you may not get the chance to fix it later. Point number one. Point number two is by the time you get to later. Jimmy Carr says it brilliantly, doesn't he? I think somewhere I've seen him say where he says like 10 years from now or 20 years from now, you'd give anything and everything to be as young as you are right now, as fit as you are right now, as healthy as you are right now, as in like you are right now. Like you don't realize that you're already like you're at the peak right now. Like you're like
I'm very conscious of that. I'm very conscious of that. Like particularly as the kids grow up,
you
see that. Like but my energy levels now are really good, and I'm intentional. But I've always been I've always had a love of health and fitness. It's been a passion of mine for years, and it's so much of my identity now. That it's just how I am, it's how I operate.
Yeah.
But it does help in other ways. It definitely helps from I do a lot of travel, as you know, the energy I need to sort of deal with the various businesses that I'm helping. Lots of stress in that, but I don't feel the stress in the same way.
No, I think it's different. I think it's growth stress, isn't it? So like in the 5, I was just relating it back to some of the stuff that you talk about in the book, because where you talk about number one point, having a clear end game.
Yep.
I think that's, most people don't have that clear end game.
It's funny when you mention it, actually, like as if it's like this brand new concept. I'm like, well, if you want something, work out what it is and then work out the steps to get there. If you don't know what you're going for, how do you know the steps? But then again, no judgment of people. I think some people just kind of get lost. They have a goal, but they get lost a little bit sometimes because they're in the build towards it.
Or they don't believe that it's possible, I guess. And I think sometimes as an entrepreneur, you just end, as a phrase I sort of have used occasionally with people, I said, when did your business take you hostage?
Nice. Yeah,
and I think sometimes people feel like the business is running them, they've been taken hostage by it rather than they're running it. And therefore, at that point, it is like, I don't know where this ends. I don't know how I get out of it.
I think that's definitely, you might have had an intention in the beginning.
Yeah.
It was clear. Then you forget. Yeah, no, that makes sense. If you get smacked around the head enough times, you're going to lose clarity.
Yeah, I think that's totally true. That's why I think having a clear end goal, but also that could apply to your healthier relationship or anything, right? It's like, what's that look like? Number 2, your point was like strengthen foundations, which I thought was interesting. So you start there.
Yep.
And you say build financial and operational infrastructure. So when you say that, what do you mean by that?
So let me unpack it a bit in what actually happens when a PE firm buys another company. Because actually that whole methodology, scale to sale, is what happens.
Right.
So you, first and foremost, when an acquisition is made, certainly if it's a platform acquisition, meaning the first business bought in a certain industry by the PE firm,
right, the
exit's already being talked about and almost decided before the deal's done.
Okay.
So we even have a conversation sometimes about who the acquirer is, like the names of businesses. If it's a company buying a company. But we reverse
Hang on a
engineer.
second. Hang on a second. I just want to stop there because I think that's a really important point, and I don't want people listening to this to miss that, because you can do that as an entrepreneur.
100%.
Work out who you're going to sell it to, and in some cases go talk to them already and say, listen, if you were to buy me in 5 years' time, what would it need to look like? I've had 3 clients who've done this, and they've been told, do this, have it look like these, numbers need to look like this, margins need to look like this, that's where you need to be, and then we'd be interested in buying you. And like,
perfect.
But now you know, because you're building in a way that someone's going to buy it, right?
That's the end game, as I define it, is a very, very clear, vivid picture of what that business is going to look like. And we break it into 3-year cycles. So even though the business might be sold in, say, 5 years, we always work back from a 3-year cadence for lots of reasons. And so that whole thing is done through the due diligence of the acquisition.
Right.
So we're sitting behind, it's not just the finance guys who are running numbers, it's we call it operations, but it's not operations like a COO or anything like that. It's the operational running of the business.
Okay.
So it's the balance in my mind between strategy and execution.
Okay.
So that's what we call, that's the operational infrastructure as I'm concerned. So we're in there, we're reverse engineering from an outcome, we're assessing everything to a really finite level of detail against risk and upside. We're looking at that in terms of that 3-year vision back to the strategy. So the strategy are the choices to get to the vision.
Okay.
And it's fully mapped out, and it's called the 100-day plan. Okay. So when you first, if you sold your company, you'll have an operating partner turn up with a team and the 100-day plan. And the 100-day plan will be something that you did help construct through the due diligence process, sometimes knowing, sometimes not. But that is the schematic. It's like the architect's drawings of what we're going to do to get this business to a level of momentum within that first 100 days. Then what happens is you just continue in 90-day sprints and increments all the way through to the exit.
Okay.
First 100 days, and the strengthening foundations piece is normally the first 100 days plus a couple of those 90-day sprints.
Got it.
Depending on how much needs to be optimized.
And you said earlier that I didn't want to interrupt your flow, but you said earlier that there were only 5 metrics you should use to run your business.
I know them.
Yes, that was what I was asking. Really,
everyone loves this.
Yeah, because you said, oh, there's only 5. You don't need 42. You only need 5. And I wrote down ask Nick about the 5.
We'll link the podcast episode to this. I call it the ultimate CEO dashboard. It's 5 things, not 40.
So give me the link and we'll link to it.
But I'll go through them because I think it's important, right? And some of them are obvious. Some of them. Whenever I say things, just a caveat, it sounds obvious, but what I'm probably not getting across sometimes is the depth. So I'll say something to you now and you go, but I'm not, when I say it, I don't mean that. I mean the depth. I mean going deep.
Okay.
So when I say the 5 things, it's the depth of understanding and what you do about the 5 things, which will make the difference versus the 40 things that you're looking at, which you're not doing anything about.
Right. Okay. Right.
So the most important thing is cash.
Yep.
Right. Private equity exists ultimately to create, turn revenue into EBITDA into cash. Okay. And when we look at it from the standpoint of runway, anything less than 12 months, red flag. Most business owners, 3 to 6.
Yeah.
12 months.
Really?
Yep.
Okay.
12 to 18 months, you can execute. Over 18 months, go for it.
Okay.
Okay, because it's all about our ability to use cash to pay off debt, to invest back in growth, all those things. So we want to create as much of that as possible. So that is the most important thing. And I learned this the hard way. I remember once it was my second CEO gig in private equity.
Right.
And the operating partner at the time came up to me and said, I was doing some BS around churn or LTV or some crap. And he's like, I'm going to stop you there. I just want to know how much cash we've got and how that's being planned over the next 9 months. I'm like, I don't know that number. And he's like, well, I don't know what you're talking about. You're talking about these other things. I'm not saying not important, but if you don't know that number, then the conversation's finished.
Right.
And it was.
Wow. Okay.
Okay.
Right. Cash number one.
Sounds obvious, but it's the depth underneath.
Yeah.
In the podcast episode, which I think will be useful for people, it goes into a lot of depth.
Okay.
So
I'm going to listen to it for sure.
You'll like it. It's good. In fact, it's only a recent one I just put out, so it's good. Because I get asked the question all the time. So I've been saying this to people I mentor for ages, but I thought I'd put it out there. The second one is your EBITDA margin.
Yep.
Not your net profit necessarily, it's your EBITDA margin. And we're looking at certain ratios against the EBITDA margin, which are, every industry has certain things that are important, but we're looking for the margin increase or decline. So if the margin starts to decline, I think we say for 3 months or more, we start to have an intervention, because it could be pricing strategies, it could be all sorts of different things going on.
Got it.
So super important. Third one is your revenue growth rate. Okay. Now, again, this is important because people think that if the revenue is growing really rapidly, that's a great thing. Or, we're doubling every year. You would see this all the time with your clients. In PE, we don't like that necessarily, right?
Really? Interesting. Okay.
Because it can hide and mask some of the other metrics we're talking about. So you can get really high revenue growth rate, but if it's affecting your margin, then that's not good. So as I go through these 5, the thing to think about is they're all building on each other. So they're not just independent, right? Different levers that you pull to drive one can have an impact on the other, and we want all of them to be green. So I have a rhythm of a Monday morning piece where you can do the work to actually assess these 5 in 15, 20 minutes. And I say to most of the CEOs that I mentor that you need to do this every single Monday morning.
Great. Love it.
So you've got revenue growth rate, then you've got pipeline coverage, looking usually at a 3 times coverage to monthly target. So what that means is that if you have whatever the target is for the month of your business, and pipeline can mean, people think automatically service businesses and that, but it can be sort of what you sell as a retail business. Doesn't matter. It's the amount of money that you need to make that month and the certainty of that coming, the predictability of that forward facing to 3 months.
Love it.
And then you put that against the conversion rate to get to your number. If that drops, say, from 3 times to 2.5 times, immediate intervention.
Right.
Okay. So that's for the fifth one is customer concentration, but can also be looked through the lens of what we call quality of earnings. So it's the quality of your revenue. Customer concentration is a big one. It's the silent killer of all deals. And it's, to define it for people who haven't heard it, it's where you have an over-reliance on a few customers for the majority of your revenue. And again, I've got ratios in the podcast to talk about what that looks like.
So it's usually over about 20% causes deal stress.
Yeah, 20, 25. And
anything over 30 normally kills it, right?
Yeah, and it's, absolutely. It depends. You can have all of those other 4 things working for you, optimized, looking really good. And then you get to customer concentration and the whole deal falls through. So the number of times I've seen deals, the business looks great, the founder thinks they're going to sell for a lot of money, the EBITDA is fantastic, but as soon as you lose 1 or 2 of those contracts or customers or clients, however you're assessing it, the business is worth nothing.
Yep.
Or a lot less.
Yeah.
So sometimes people say, well, actually, I don't have an issue with it. So let's say, for example, you've got a business with hundreds of customers and they're all equally dispersed. So therefore, I don't need to look at the 5th metric. I say, we'll then start to look at your product or customer segment profitability. So it's not just the customer concentration, it's the value that's being attributed from the way that you decide to go to market.
Yep.
That's what it really is.
Understood.
So when you package those 5 things together, it's not to say that there shouldn't be other metrics, but what I say to most CEOs is, these are your numbers. It's not the CFO's numbers. These are your numbers. LTV, CAC, that's your CMO's number.
Yep.
It's not that's not important. It's just not your number.
It's not your number, yeah.
You need to know these 5. So the way I visualize it is you're looking at these every single week. Some of those, by the way, are kind of weekly, monthly, quarterly, but we still look at them weekly. And then if there's anything else that's important, of which there will be, right? That sits underneath that.
Nice.
And that's how I think about it. Again, it was
team stuff or team happiness score or team that kind of thing.
Not there.
No, it wouldn't go there, would it? It would go under.
It's later on, but yeah. I talk about this on the podcast episode saying, again, remember I'm looking at it through the lens of you're sitting in a PE board. So it's not, default to everything. And maybe there are certain situations where that may not be 100% accurate, but no one cares in private equity about your employee engagement score if those 5 numbers are not working.
So these are the 5 that, okay, so let's just run through them.
Okay, so to go through, so you got cash runway,
yep,
EBITDA margin, growth rate, monthly or annual, depending on how you're doing it, pipeline coverage, and customer concentration, or analysis of your customer universe, right? So it's the detail around that. So you can build this out a little bit so it is tailored to your business a bit more. But ultimately, we're looking at, in other words, the ratios underneath, the detail, the depth, but they're going to be the same things.
Love it.
That sits at the top. And if you know those and you've got the rest kind of being managed, you're going to be you're going to be building value. And here's the thing I say quite a lot. If you don't know those 5 numbers, or you don't know how they apply to your business, you don't know how to build value in your business.
Yes.
Right? And that's a really, in my world of value creation, expansion, that's a dangerous place.
Yes.
Because it creates risk, but also it just reduces all optionality for you.
Yes. Because you're not creating an asset.
Yeah, you're not building a investor grade asset.
Yeah. I love that.
Yeah, it's cool. It's again, it's not, you would have heard all those things before, but it's when you really go deep into that and you look at it, you'll start to see the way those things really play off each other, and that's the level of precision that PE works at.
Yeah, I think for me, I mean, they're all great, and I would agree. I suppose the one that sort of just made me sit back and go, I mean, customer concentration, I get, because one of the first things we do when we start coaching a client to scale is look at customer concentration, or industry concentration could also be a risk. The flip side of that is supplier concentration too, can be an issue, in terms of if you've got one big supplier that's supplying 90% of your stuff.
100%, yeah, absolutely.
And we've had a client recently who 90% of their business is all in the US. Well, with tariffs and stuff, it's caused all kind of interesting challenges with that one, right? So, yeah, I mean, I think that a universe...
That one is the one that can flex the most based on exactly what you said. So it's really a risk that sits at a point around how revenue is built. So if you said supply concentration and you're a e-commerce business, and you've got one supplier providing all your product and that kills revenue, then that would be the same thing.
Yes.
Just to be clear. The other 4, depending on how you define pipeline, but the other 4 are kind of just what I call table stakes again.
Yeah.
You've got to understand that. I was with a business this week just talking about pipeline coverage. And even though this business is doing $8 million a year in revenue, their whole sales team was not doing anything on that. It's all, literally eat what you kill that month, start again.
Yeah, and I think a lot of people do that though, right? I think a lot of businesses, Nicola, who's recently joined my team, who comes from a sales team in the construction industry. She ran a business that was doing 17 million, or a business division that was doing 17 million, and she's all about helping our clients focus on sales team performance, but also just that pipeline coverage. Like that's literally her job, is to go in and work with our clients now and go, look, I'll do the strategy. We've got another coach who does the team stuff, and she goes in and really works with them on pipeline coverage. And most of them, when we sit down, they don't know. They're not tracking it. They don't really know. And I've always, for me, look, that pipeline, I love the phrase, by the way, pipeline coverage is really your future projection on cash flow, right? Yes. So like, if you don't know that, how do you know when you're going to run out of cash or not run out of cash? And it's the quickest way to generate cash, isn't it? Because if you can take a conversion rate, most sales teams, if they're averaging 20% conversion rate and you just do some basic sales training or give them some good sales training and take it to 35, that's free money, and that ends up being free cash, but also a massive value creation because it normally boosts the EBIT.
Exactly. And that's the point of the 5. So everything you just said there contrasted 3 to 4 together.
Yeah.
They all work together. So 2 things I notice is most people don't understand the 5, and that's why they confuse themselves with too many other things.
Yeah, that's true.
If they do understand the 5, they don't understand the interdependencies of the 5. And if you want to get, really good value creation, but also means high income, so profitable growth, it's understanding those levers. And profitable growth means more income for you, even if you don't sell the business.
Yeah.
So there's that benefit too.
Yeah, I suppose the one that just sort of made me go, ooh, that's interesting. Like saying that if you haven't, most of the clients, we get at least 90 days to 6 months worth of cash.
Yep.
Because you can normally figure most things out in that space of time. But to think about 12 months, that requires a different level of discipline, I suppose, right?
Yeah, it's also, if you think about that, we want to be, the reason we're looking at cash, we're not looking at it always through the lens of running out.
Okay.
We're looking at it through the lens of kind of what's the cash conversion of the EBITDA.
Right.
So even though we call it runway, people think runway automatically means the runway is going to stop. The runway can continue. So cash runway allows us to invest in growth as much as it causes risk.
Got it.
So we're not just looking at it from the perspective of,
no, that's an interesting distinction, right?
Yeah. And I think it's an important one on the basis that if I have a, think of the ATM analogy, if I have this thing that's spitting out money, look at the choices I have. Firstly, in private equity, we want to pay down.
Just explain ATM to people.
Sorry.
Ascending transaction model.
No, ATM's the American way of saying a cash point machine.
Oh, right, okay. Because I wasn't sure which way you were going, because obviously I know Daniel Priestley calls ATM a sending transaction.
No.
order,
I'm talking about the thing in the wall that spits out cash.
Cash machine.
Cash
Yay!
machine.
If you're listening in America, it is an ATM.
Sorry
yes.
about that. I spend so much time.
No, it's an ATM in America. So I was just making sure. I thought you meant something else.
No, you're right. Sometimes I'm on plane so many times though, Paul, I have to work out where the hell I am. No, and you'll notice I say dollars and pounds quite a lot.
I've stopped. I'm reducing the amount of times I say pounds now, because I think we're global, right? If we,
I talk about US currency as being the global currency mainly, but anyway, So the point I'm getting at is that if you think of the business from the perspective of how can I make this as cash generative as possible, then you've got the choices of what you do with that.
Yeah,
and that's the key thing. But it starts with obviously the revenue growth. So if you think about it, they all interrelate together.
They all really do. That's a really great.
And that's why I think it's a nice little ecosystem in its own right.
Well, it's a CEO dashboard, right? That's basically what you're talking about. It's a CEO dashboard, and I think sometimes, funnily enough, we had it yesterday in one of my mastermind meetings. Was one of our CEOs was going, okay, I'm trying to collate and data, and what should I be pulling together? And actually, I've just got almost too much to look at now. Like, I've got loads of it, but actually, I've ended up with too much of it, right? So sometimes I think the power is, good old Alex Hormozy, simple scales, complex fails, right? So actually, how do you simplify everything down to like 5 numbers? Great, I can run my business.
You make a great point. I didn't say this earlier, but the other contrast with private equity is it's all about simplicity. So people think it's complex and structure and rigor and all those things. I can tell it's so simple. The more that point I said about when I got told off by the operating partner.
Yeah.
I learned a lot in that particular role, because everything was about, well, why are you showing me, and this is an interesting thing. When you go to a board meeting in private equity, certainly when I was at Blackstone towards the end, it was a one-pager.
Really?
So you turn up. It was called a business review meeting, and we would turn up. So the private equity firm was there as well, the group CEO. I was the CEO of one of the divisions in this business, and everything was on one page. Now, there were appendices at the end of that you prepared just in case you had to explain your one page.
Okay.
But it wasn't 40, 50 point PowerPoint. In fact, if you did that, you'd be out, right? If you can't explain this business on one page for this month, then there's something wrong.
Yeah.
Incredible. So I gave this actually to one of the businesses that I advised recently, and I showed them the exact, got a business unit review of Burr. I showed them the exact pack that we used a few years ago, and they just couldn't believe it. They're like, we've got like a board pack that's like this. I say, why? Even if everyone reads it, what's the point? Like, if you can't analyze what's going on in your business in that one page, then you're trying to do too many things. Now, what would happen though is if we used to do it by RAG status, red, amber, green, different things going on. If anything was red, back to my point before, immediate intervention.
Right.
So that 1 hour meeting to talk through what was going on, sometimes it finished quickly if everything was green. There was another meeting, right? We're now gonna go deeper. But if everything is looking good because it's all structured in a way that is, then there's no point having a long meeting. So move on and execute.
Yeah. Well, it's that, you said it earlier, actually, that ruthless obsession with execution, right? Like, if it's going to get in the way of executing, unless we absolutely need to spend time fixing it, why are we talking about it? Precision
on what needs to be known, super precise and deep where it matters, and then relentless execution. Strategy, less important. Strategy happens in a very contained way, and it's done by multiple people, not just one. So if you're the CEO in a private equity business, you don't own the strategy. The board owns the strategy. You create the strategy with the board. You are responsible for execution with your leadership team.
Why do you think, just sort of, because I think this would be a nice place to kind of draw it to a close, like, why do you think most entrepreneurs don't think about building a board?
Yeah, it's a great question, because I get resistance sometimes when I'm working with people, because I often say to them, a board doesn't have to be a complex thing. Like, you going in as a coach or me going in as a mentor or whatever, that can be the beginnings of it. And I often say, just have an advisor. Just start by having someone who's going to call out your BS, who's going to challenge you, support you when needed to, right? It's not just about that.
Yep.
And get used to having some sort of external perspective, right, to help. I think these are the things I think. Ego gets in the way, right?
Yeah.
That's one big one for certain types of characters. Fear that I'm going to get called out.
Yeah, that's true. That's 100% true.
Like, maybe I'm not as good as I thought I was.
Yeah.
Right. it's like taking medicine. You know, you probably need to know it, but you don't want to face up to it, right? It's that. Sometimes it's silly things like, oh, I can't afford it, cost. And you think, are you serious? Like, you know, I get it, but people are looking at the wrong things then. Like all the great businesses, all the best ones out there have got boards around them, and it's all about the power of the network that creates.
It's a mastermind, isn't it? Yeah. I mean, I often say to people, I say a good board, like I've just joined the board of a £22 million company in the education space. And like there's four of us, and then all the managers report into the board. But it's two things. I think it's two or three things of why boards are powerful. Number one, the accountability piece to actually have the meetings, because if you don't have a board and someone is chairman and someone's sitting in the space and doing that, they don't happen.
Yeah.
Two, this is interesting in terms of data. Boards that meet every other month versus just every quarter perform much better. Mm-hmm. So because they go 6 meetings a year versus 4 meetings a year, so you catch stuff quicker, you figure stuff out faster, and you see things that are not right, and you change them. So, but I think, like, for me, a board is a mini mastermind. So you should have 5 people. And that's why, like, bringing a chairman who's been in the industry, who's retired, but has got like 25 years experience, that saves you so much time and effort, because his perspective, plus he or she, by the way, can open loads of doors or whatever. Like, just build a mini mastermind, because that's what it is. And if you think about it like that, it's like one of the most powerful things you can do. And
I think sometimes people just don't. The same people who are challenged by the idea of a board are the same ones who almost get challenged by their own growth and development sometimes.
Yeah.
Yeah, so I think it's, if you understand that the only way you're going to grow is putting yourself in different rooms, right? Yes. Like was what I did you did with Tony Robbins, then it makes total sense. And the other thing I say, it's slightly different from my lens, is if you ever want to sell to private equity, which is the bulk of where the big 8 to 9 figure exits exist,
True.
Right? You know,
True.
And they're either private equity standalone or a company that's already been invested in, you're going to get a board. If you can, it's in my 15 reasons why, you know, you may not sell, because if you have a board before you sell, it tells the private equity firm that risk is mitigated because you can operate with governance and structure, right? Oh, so this guy's not going to.
You're not a maverick. Out. Basically, you're not a maverick.
100%. And then the last point that I think we haven't touched on is, you know, boards, it's the leadership team, it's the people around you, but it can be a great development tool for the managers and the people under.
Totally.
So the board I sit in London for a fintech, we use it as we do them twice monthly or bi-monthly, your point. We'll have 2 or 3 heads of functions come and present.
Yes.
And they get feedback from the non-execs who are on their board, and it's great development.
Yeah. And that's what we're using the board. That's how that's being developed. We've got some of my coaching team going in developing the managers and the leaders of the business units, which is great. And then they'll come in every 2 months and present to the board as part of that process. Perfect. So I really endorse that as a leadership development model as well, right? Yeah. 100%. So obviously, we didn't have time to cover all 15 on the podcast today, which has been great.
I probably can't remember them all.
No, that's fine. It's all right. But they obviously, if everybody goes and grabs a copy of your book, all 15 are in there. So Exit for Millions, available everywhere, I'm assuming, or is there anywhere you want people to go to grab a copy of it?
It's in bookstores, and it's in, Amazon's the obvious one, I think. And just in case people ask, no, the audiobook hasn't been done yet.
Yet. But the book took 2 years. So, you know, give yourself some...
I'm so glad we skimmed over that, please. No,
we need to, but good things are worth waiting for, right? So I think I'm sure the audiobook will come fairly quickly, right?
Yeah. It's in the making. I want to do it. Well, I'll tell you what I'm going to do. I want to do it. Like, you can do AI these days and stuff like that, but I actually want to read it. And David Goggins, in his first book, I think it's Can't Hurt Me, he does like a little podcast at the end of every chapter. So it's almost like a cookie type of thing that happens. So he reads it, or someone reads it, and then he turns up and says, "This is what I was thinking."
Yeah.
So I want to do the same thing.
Oh, nice.
So when I talk about the 15 reasons, which is one of the chapters, I'll then sit there and say, "Well, why are they that?" You know, because I don't go into that level of detail in the book.
That's interesting.
So that's the plan.
Okay, cool. Well, yeah. I suppose the only question, I've got a question for you. Firstly, thanks for today. It's been a brilliant conversation. I'm glad we got the 5 covered off at the end, because I felt for me that was a really nice meaty thing that people can go away.
As you said, from what you want to get across.
Yeah, and I wanted to get some practical stuff in there before everyone goes away and really understand that scale to sale methodology piece around that. And I think the other point you just made is brilliant, is that if you want to do a 6 or 7 figure exit, then PE is probably not where you need to worry. there are other people, trade sales, EOTs, things of that, vehicles like that.
Yes.
Some of which we've talked about on this podcast with people who've done EOTs, and Ken's talks a lot about trade sales in his podcast. So there are other ways to do it. But if you want a sort of 7 or 8 figure exit, you need to understand the world of private equity. Sorry, 8 or 9.
So private equity usually don't play unless your EBITDA is at a minimum 3 million up to 5 million.
Okay.
And so at 3 million on a basic valuation, you're going to be 15 to 20 million valuation.
Well, that's a great goal for people to have as well, is to know, right, if I want to sell for that, I need to hit 3 million EBIT. That's my goal.
That's your minimum threshold. And quite often, just to say this, like people come to me and they might be at, say, 500K of EBITDA and the goal is an 8-figure exit. We don't talk about the exit. We talk about the bridge to the profitability. And if someone knows that they need to go from 500K to 2 or 3 million and then more, it feels more possible.
Yes. Got it. Brilliant. Well, listen, my final question is, what's your definition of a grown-up business?
Let me give you a considered answer on that.
Yeah, take your time.
What I think it isn't is, a big corporate or anything like that, which has lots of structure and process and things like that. I think that may be evidence of a business that, has put certain things in place. I think it's a business that operates with clear intention, clear levels of focus and discipline, doesn't get distracted like a juvenile or a kid would by the shiny objects, right?
So true.
And as it sounds, it operates with a level of maturity that creates a degree of predictability and repeatability.
Yes.
Right.
Yes,
so
that's true.
Because if you think about it, like when you're a kid, everything's exciting and fun and all that, and you're jumping around the place. When you get wiser, right, you tend to stay the path a little bit more. I think a grown-up business has a certain wisdom to it, certainly from my
maturity, I think, is like that. Yeah, like that. Well, listen, thank you so much. I know how busy you are. I know how much we had to work to get this in your diary and my diary, and I think it was so worth the wait. And so worth having you come and sit down and do this face to face, because it's been an awesome couple of hours. It's just flown by for me, and I've made tons of notes too. So listen, thanks ever so much indeed. Obviously, people can follow you on all the platforms, but LinkedIn's probably one of the best ones for you.
LinkedIn, you can find me. I'm posting there daily. Obviously, have a listen to the podcast. We'll put a couple of those episodes in.
Yeah, I think that'd be brilliant.
But I like it when people, if they've seen this conversation, there's something that's resonated. Just message me on LinkedIn. We get back to everybody. We love that. It's a great medium for communication. So
fantastic.
But I've had a great time. Listen, I love our conversations, Paul.
Every time I talk to you, I'm always inspired, and at the same time feel like I need to go and get more education around this subject. So, which is a good thing, right?
I think you know a lot about what you do, and you know what I've noticed with you though is that you do go out there and get that education, and you surround yourself with people all the time to kind of drive your growth. So, if I can do any of that through what we're doing here, and that helps, and it helps with what you're doing with your clients and your stuff, that's great.
Well, I definitely think the 5 CEO dashboard elements you've discussed here, I mean, one of the first things in our grown-up business framework, obviously we talk about level up, team up, scale up. That's the way we approach it. And I think one of the first things we always talk about is leveling up the data that you're looking at. That should be one of the things you're looking at leveling up. And I shall use your framework, credited to you, in terms of, right, look, as a CEO, these are the first 5 things you need to level up looking at. So thank you for that, because it will absolutely feature as something we teach, which is brilliant, man. Awesome. So listen, have a safe flight, have a great trip to America, and stay healthy. And thanks for being an incredible guest on the show today. We'll see you on the next one. Take care.
Thank you.
That concludes this episode of the Grown Up Business Podcast. I hope that got you fired up and ready to grow. The key thing, though, is to remember you get paid on what you get done. So write down the top 3 actions from the show and make sure that you implement those in the next 72 hours. Hey, and while you're at it, make sure you click the links and the resources below this episode to claim free growth resources to help you build the business you desire and deserve. I'll see you on the next episode.